We're clearly engaging in a trade negotiation dance. As much as we want to know the answer, we got to go through the dance.
It's all about trying to figure out what the market's pricing and therefore the risk distribution around events.
There are companies that are going to be winners in all of this, and there are companies that are not going to win.
Going this way, going that way. There's going to be a zigzag back and forth, and I think it is hard to pin those things down.
It's impossible to do in terms of trying to game out or forecast what's going to happen.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Each trading week is just like one long day, never ending, just one very long day. It's Wednesday. Live from New York City this morning. Good morning, good morning. Bloomberg Surveillance starts right now with equity futures down hard. On the S&P 500 by 0.5%, on the Nasdaq 100 down by 0.9, a 1-2 punch to tech sentiment. Let's start with Apple. According to our reporting here at Bloomberg, China's antitrust watchdog is laying the groundwork for a potential probe into Apple's policies and the fees it charges app developers.
Yeah, they take about a 30% cut of in-app spending. This is something that's been probed elsewhere, too. Let's be very clear about this. The other notable thing about this investigation is it started by Chinese authorities late last year, so not necessarily one to put into the tit-for-tat that we've seen with respect to China and the U.S. Nonetheless, another dent in sentiment that's already been eroded with the shares lower in pre-market trading at a time where people are really questioning whether the biggest winners can keep on winning in 2025.
These are the champions of corporate America, and they've now got a target on their back. If you go back to the inauguration, we said at the time, just the day afterwards, that was a celebration of everything that was great about American corporate America and American champions of tech. They've now got a target on their back as well. And you can see that foreign countries, nations, adversaries and allies see that as a potential pressure point for this administration. We saw that when the threat of tariffs on Canada came about. What was the first thing one province in Canada did? Came out and said, you know what, we'll cancel the Starlink contract. We'll go after Elon Musk. This is just the first or second time we see of this. I think you could see more to come in the year ahead.
Well, we saw that already with Tesla sales in France plummeting more than 60% in December, maybe in response to some of the back and forth that we've seen between the governments. Key issue is how long-lasting is this versus get it all out of the way, come out with the bazooka of pretty radical suggestions and see what sticks.
I said a 1-2 punch to sentiment. Here's the second punch. It comes from Alphabet. Check out these numbers. $75 billion in 2025 capex. The estimate was 57.9. Cloud revenue slowing as well, taking some wind out of the stock with -7%.
So to me, I looked at these numbers and it was a disappointment, and it wasn't that big of a disappointment. But what it highlights is that the expectations are very high for a lot of the big tech players, and their ability to meet those expectations is getting lower because of capacity. The fact that they still are saying that capex is the way to go and that it was so much higher and it will be so much higher than people expect highlights how they don't think that they can win unless they spend that money, and they're still being penalized for it.
Amazon results just around the corner as well. They're about 24 hours away. Stacked day ahead for you too. Let's go through some of it. Economic data a little bit later. We'll get the ADP report. Jobs came out. Job openings a bit lower than expected yesterday. ISM services data due after that, so look out for that as well. Then we get some Fed speak. We'll catch up with Tom Barkin, the Richmond Fed president, a little bit later this morning.
And it comes at a time where Fed officials have largely been talking from the same hymnal, that they have a good chance to just wait and see what the data shows. But a bit of divergence. Yesterday, Fed Vice Chair Philip Jefferson came out and said he still continues to see gradual rate cuts throughout the year, whereas Mary Daly of the San Francisco Fed came out and said, we have to make sure that we get our inflation down. 100% of my energy is devoted to getting inflation to target.
We've got time. We can take our time. Seems to be a new way of saying we've got no idea what happens with tariffs and changes of policy down in Washington, D.C. Equity futures right now negative by 0.5% on the S&P. The loss is bigger on the Nasdaq. We'll be talking about tech throughout this morning. Coming up on the program, we'll catch up with Kennon of Clear Harbor Asset Management on the latest tech jitters. Michael Townsend of Charles Schwab with Trump in no rush to talk to Xi. And Stefan Slowinski of BNP Paribas following disappointing results from Alphabet. We begin with our top story out of Washington. President Donald Trump saying the United States should take control of the Gaza Strip.
I don't want to be cute. I don't want to be a wise guy, but the Riviera of the Middle East, the U.S. will take over the Gaza Strip, and we will do a job with it, too. We'll own it and be responsible for dismantling all of the dangerous unexploded bombs and other weapons on the site, create an economic development that will supply unlimited numbers of jobs and housing for the people of the area.
Joining us now from DC is Bloomberg's Annmarie. AMH, let's get straight to it. That one was unexpected.
Unexpected, although Trump has flirted with this idea last week and even earlier in the Oval Office. But he was pretty serious and firm last night in that press conference, saying this is his vision for the Middle East and for Gaza. It was unorthodox, way out of the box, has been described to me. Some in Israel who are looking well on this think it's a bold vision. What I would say this morning is adversaries will look at what the President of the United States said last night as a land grab. But at the same time, this could spark, and already has, fierce debate, which may mean that other individuals may actually come to the table with ideas. Because at the moment, what is the solution when it comes to Gaza? The issue, and what I really question, is the president's policy last night, stated policy, this is something he wants to do, he's looking into, kind of undermines his big picture of what he wants to get done in the Middle East. And I'm talking about normalization between Israel and Saudi Arabia. Remember, Trump 1.0 brought normalization with a number of Gulf states, the Emiratis, Bahrainis, with Israel. And Saudi Arabia last night, almost immediately, I believe it was 10 minutes after that press conference, put this statement out. The foreign ministry affirms that Saudi Arabia's position on the establishment of a Palestinian state is firm and unwavering, and it continues to say they will not establish diplomatic relations with Israel without that. So by talking about what he wants to do in Gaza, he undermined his big goal for the region.
Annmarie, do we have a sense of, in back channels, what this discussion is like with allies in the region, Middle Eastern powers that could potentially have a role in prolonging the ceasefire and getting some sort of solution?
Yes, and the back channels say that these countries, whether it's Egypt, whether it's Jordan, a really important meeting next week now is going to be President Trump's sit down with His Majesty of Jordan. That is going to be incredibly important because Jordan, Egypt are very reluctant to take in more refugees. And none of the Arab states want to either. Part of this also is because they want to make sure that Israel does not just take over Palestinian land in Gaza. So there are back channel talks about this, but I have not seen a single country in the region move on their willingness to take in Palestinians. So this is going to spark a tremendous amount of debate. I would also say, because we are also focused on the president's comments on Gaza, we are not talking about the second phase of the ceasefire. And it feels like Prime Minister Benjamin Netanyahu got a pass last night. This is something Steve Witkoff wanted to see Trump's envoy for the Middle East, wanted to see the Israelis really commit to. Those discussions are happening now. And Netanyahu is dealing with a very right-wing government that potentially doesn't want to see a second phase and want to make sure they can go back in and eradicate Hamas. There was very little discussion of that last night, and I imagine is going to be this morning.
Annmarie, appreciate it. We'll catch up with AMH again in about 10 minutes' time, so look out for that. For those of you just tuning in, equity futures down across the board here. We're negative by 0.5% on the S&P. Aaron Kennon of Clear Harbor Asset Management joins us now. He writes, we continue to believe equities will outperform other major asset classes. However, elevated valuations suggest more tempered expectation for future returns. Key concerns include if tariffs bite instead of just bark. Aaron joins us now for more. Aaron, welcome to the programme, sir. Good to see you. It's been too long. Let's talk about sentiment. Sky high coming into 2025. Is that bark sufficient to dent sentiment?
Well, we'll see. Certainly the first sort of volley around tariffs, Jonathan, has been more bark than bite. Mexico and Canada, we'll have to see what happens in China. But certainly there is sort of the silver lining in all of this, which was alluded to a little bit even with your conversation around the Middle East, which is tariffs 2.0 for Trump are very much not just about trade. They're about foreign policy and border policy. And so we'll have to see how he uses that tool and whether he's effective in using that to affect some foreign policy outcomes. I mean, the issue in Ukraine, the spat with China on multiple fronts, including their covering the back of Vladimir Putin, could all come into play on tariffs. And I think that's part of sort of the potential grand bargain that we could see across multiple fronts, which could be could boost the risk on trade. But for now, lots of uncertainty. It's the risk off trade. No one wants to lever up. They want to take risk off. and we'll have to see.
Aaron, you talk about some of the unknowns, and that has to do with tariffs and global policy. Some of the knowns are some of the earnings that we've gotten recently, in particular from Alphabet, from AMD, showing that there was a very high bar and an inability to clear that very high bar. Is there a tell in that essentially this is the moment of either transition away from some of the big winners last year to everyone else, the adopters this year, or if it's just really maybe valuations are just too high?
Well, certainly the last 2 years, Lisa, the narrative has been AI growth. NVIDIA's been the poster child of it, but also statistically the driver of that outperformance. Technology, massive outperformance in the S&P 500 last year. This year, it's the leading underperformer of all the sectors through yesterday. And I think the market is rethinking, how the evolution of AI is going to play. Who are going to be the winners? Will they be last year's winners, the hyperscalers, or will they be the future winners? Maybe the data storage companies and segmenters of data storage and the like. And so it's going to be quite interesting. But for sure, if you look at equal weight this year in the S&P 500, it's outperforming market cap weight. And we think there's plenty of opportunity outside of technology right now to take advantage of some of the themes. I would also just say, too, that AI and the discussion, the bullishness around AI accrued over the last couple of years, not just to public technology, but to private equity. I mean, every pitch book that I saw come through my office, mega private equity firms, they were about infrastructure, but it was digital infrastructure. It was AI, it was data centers, it was the utility build out. And so I'm sort of curious to see in the coming weeks how those pitch books will change.
At a time when it's unclear whether they will get the same benefit due to efficiencies. Aaron, putting the ideas together of the geopolitics as well as the tech story, something John brought up earlier with respect to Apple, which is how much of a liability is it to be a national champion in the United States at a moment where suddenly this becomes a potential negotiating chip on the other side by potential governments that are looking over at the Trump administration and trying to get attention?
I mean, certainly it's a risk. We saw some of that play out in Apple's numbers. We're seeing that play out this morning and in the headlines with China and Apple. But I will say there are smart people at Apple strategically thinking about their supply chains, not just the demand side, which is partially out of their control in China, depending on sort of geopolitics, as you just alluded to. But the good news with Apple is they've moved a good deal of their production to places like Vietnam and India and elsewhere. And so, we're hopeful that that this is really just a diplomatic sort of move on the part of China ahead of tariff conversations with Trump and Xi.
Aaron, as you know, that friction goes beyond just tariffs, and I think we're finding that out pretty quickly this morning with the likes of Apple and other situations too. Energy was part of the story over the weekend, coming into this trading week as well. One sector you like is energy. We'll catch up with the Chevron CEO, Mike Wirth, a little bit later on this morning. What is it that you like about energy right now?
Well, there are components of energy that we like. We think the LNG demand from the United States will continue to remain relatively strong. We think natural gas demand will remain, as a result, relatively strong. So you want to be in the right basins geologically. You want to be close to LNG export facilities in that regard. We think there's probably going to be a little bit of a rethink around the, pivoting a little bit to utilities on this point, but the degree to which electricity demand is going to be required around AI. Yes, Constellation Energy is up a great deal year to date, but we'll have to see how this all plays out with data center growth. But we do like the natural gas side of things to the extent that we see global growth pick up on the margin. We could see the price of oil pick up as well. We also see huge opportunities in Europe and internationally. We talk about forward multiples. Lisa mentioned or alluded to forward multiples in the United States. They look quite expensive. You look at Japan, you look at non-Japan Asia, and you look at Europe, and there are a lot of opportunities there trading at 9, 10, 12 forward PE multiples. And it's not just because they are exposed to sectors that tend to be cheaper. There are also some opportunities there as well.
I've got to push you. That was true 10 years ago, and it was a long decade of underperformance. Why is it different now?
Well, that's a good point. I think part of this potential for sentiment is very weak right now in Europe. And I would argue that if you look at the banking sector, the growth opportunities are there, but the price to book valuation is not. And, at the end of the day, too, I think that there are industrials in particular in Europe that are going to be, probably more positively impacted by the NATO build out, the demand for European countries to spend more on their defense. That will not just accrue to U.S. defense manufacturers. That could accrue to countries like Norway, Sweden, the UK, France, Germany. But then again, the headwind remains in the auto sector, for example, and that's a big component of Europe. So we want to be a little careful there.
Aaron, appreciate your time. It's good to see you. Let's do it again soon. Aaron Kennon there of Clear Harbor Asset Management. Futures right now negative by 0.5% on the S&P with an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. Alphabet shares are trading lower in the pre-market, down 7% after the tech giant behind Google reported earnings that fell short of expectations. Revenue came in lower than analyst estimates after growth in its cloud business slowed. Still, Alphabet plans to invest $75 billion in CapEx this year, far more than analysts expected. Meanwhile, the U.S. Postal Service is temporarily suspending inbound parcels from China and Hong Kong. According to its website, letters and flat packages from the region will not be impacted. The move comes after President Trump imposed a new 10% tariff on all Chinese goods. And now the latest on the mid-air crash between an American Airlines jet and an Army helicopter. The remains of all 67 victims have been recovered from the collision. According to the NTSB, the latest data shows the Black Hawk was flying at about 300 feet at the time of the accident. That's about 100 feet higher than allowed in the area. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, holding firm on a trade war.
We're going to do very well against China and against everybody else.
Any update on when you would speak to President Xi?
No, we'll speak to him at the appropriate time. I'm in no rush.
That's one call that did not happen. That conversation up next, live from New York this morning. Good morning. Equity futures on the S&P negative by 0.5%. In the bond market, yields are down by 4 basis points. To break at 450, 447. Job openings coming in much lower than expected yesterday. Next stop for another read on the labour market later on this morning, 8:15 Eastern, the ADP jobs report. We'll talk about that a little bit later. And the surveillance this morning, holding firm on the trade war.
We're going to do very well against China and against everybody else. I've never seen the deficit with China is about $1 trillion. Think of it, $1 trillion. They're using our money to build their military. We are respected again as a nation, maybe at a level that people haven't seen for many, many decades.
Any update on when you would speak to President Xi?
No, we'll speak to him at the appropriate time. I'm in no rush.
So here's the latest this morning. President Trump downplaying China's retaliatory tariffs against the United States and saying he's in no rush to speak with Xi after previously saying he would have a call with him in 24 hours. Annmarie has more from D.C. Hey, Annmarie.
Hey, John. So far, no call between Trump and Xi, but potentially there will be one. And I'm joined now by Michael Townsend of Schwab, Managing Director of Legislative and Regulatory Affairs, to break down all of this. Michael, we're entering the third week of the Trump administration. What are you telling clients when they see these tariff and trade headlines? Almost whipsaw within 24 hours. They're on, they're off. But when it comes to China, they've stuck.
Yeah, first of all, I'm telling clients you can't overreact to everything. There's so much going on right now that you can't jump at every noise. But I think you're right. China's different than Colombia, than Canada, than Mexico, where the threat of tariffs was there, and then almost immediately talk started happening. China's a longer game. It's going to be a longer game. We always knew it was going to be a longer game. So when he says I'm not eager to make that happen in the first 24 hours, although he did originally say that he was going to do it in the first 24 hours. I think that's where he's coming from. He understands this is a much longer game with China.
What's the ceiling when it comes to tariffs on Chinese goods?
I don't know that there is a ceiling. I think it's going to be this kind of incremental tit-for-tat kind of situation. So you'll go for a while at 10%. Then maybe if there's no progress, you see that tick up a couple percentage points, something like that. We'll have to see.
And when it comes to China, what makes this go around different than phase won in the Trump first administration.
Yeah, I mean, I think it's a continuation. A lot of people don't even remember that the tariffs from 2018 and 2019 are still in place.
Yep.
So this is on top of that. So, I think the president feels probably stronger than he did the first time around, and I think he's willing to play a longer game with China. So, again, we'll have to see how it all plays out.
I want to also talk to you about what's going on the other side of Pennsylvania Avenue when it comes to Congress. Everyone is focused on what's going on in the Oval Office, but we are almost a month away from a government shutdown. This summer, we are going to hit the debt ceiling. This is all before we get what the market would call the good stuff of tax cuts. How do you see the sequencing of this going down? Because the Republicans have the slimmest majority they've ever held historically.
And it's actually going to get slimmer. When Elise Stefanik resigns, it'll be one seat in the House of Representatives. So I think this is going to be really, really difficult. We're already seeing signs that it's difficult. The House of Representatives, Republicans plan to consider a budget resolution, the very first step in the sort of gigantic package that's going to include taxes and lots of other policies. And they were planning to do that this week, and they couldn't get there. So they're still negotiating internally. I think the Senate is eager to get going. And we may see the Senate take the lead here before the House of Representatives in the coming weeks.
If the Senate takes the lead, does that mean this one big, beautiful, powerful bill becomes two?
I think it increases the chances, no question, that it becomes two. I think that the Senate is sort of looking at it as, we can do things like energy policy, border policy, maybe get some wins on the board fairly early. If we start putting taxes and debt ceiling and some of these other really complicated things into it, it's going to take a really long time. Will Trump have the patience to wait that out? So I think that's where the Senate is coming from. Let's get something on the board maybe a little early. I don't know whether the House of Representatives will agree to that, but I think that's where there's this divide across the House and Senate.
You talked on your podcast last week that bond market investors are very uncertain and very uneasy. What are they paying the most attention to?
Well, I think they're trying to pay attention to everything, which is probably, not
the market really can only
best
focus on one thing at one time.
You can only pick a few things to pay attention to. And, what we've been telling people is that this kind of, bursts of uncertainty is going to continue to happen. We think there are going to be tariffs, and then the tariffs are pulled back. But the tariffs could come back on March 4th. This is a 30-day pause. So I think there's a little bit of whipsawing that's going to go on here. And, bond investors who traditionally want to sort of see a longer term and have a clearer path may not have that opportunity here in the coming weeks.
What's the most underrated issue right now that you don't think people are focusing enough on?
Yeah, to me, it's the debt ceiling. The debt ceiling is going to be really, really complicated on Capitol Hill. You've got a bunch of Republicans who have never voted for a debt ceiling increase. And Democrats don't really at the moment have any incentive to help out in that situation. So I think that's kind of the underrated one. They're going to try to package it with California wildfires, maybe something like that.
Democrats already said no to that.
Exactly. But
this is going to be a challenge.
I think it's going to be a real challenge.
Michael, thank you so much for your time this morning. That's Michael Townsend, Jonathan, of course, from Schwab, Managing Director of Legislative and Regulatory Affairs. He says the biggest underrated item to watch in Washington right now for the market is the debt ceiling, and potentially we can hit that this summer.
Annmarie, appreciate it. Thank you. You've got to be across a number of things simultaneously at the moment. So let me bring you the latest on the Middle East. This coming from the President of the United States, Donald Trump, posting on social media this morning, reiterating something we've heard from him before. I want Iran to be successful, but it can't have a nuclear weapon. On Iran, I prefer a verified nuclear peace agreement.
And then he says, God bless the Middle East, after he says that some of the reports are greatly exaggerated, that the U.S. and Israel are going to blow Iran to smithereens. I guess this to me is interesting because of all the things that he said. It seems maybe that's gaining the most concern in the Middle East at a time when there are some pretty complicated negotiations going on. Watch this space, because the conversations are continuing in pretty robust form behind the scenes.
We'll catch up with an official from this administration on this subject. Morgan will take us a little bit later on this morning, so look out for that conversation. It's about 50 minutes away. Up next on the programme, Stefan Slowinski of BNP Paribas Exane, as Alphabet's cloud sales fall short of expectations and the CapEx numbers come in big. That conversation up next. Equity futures declining across the board here. We're down by about 0.5 on the S&P 500 after snapping a two-day slide in yesterday's session. We start to eat into those gains. On a Russell, just about unchanged, positive by 0.2%. These moves today, all about tech. We'll talk about tech in just a moment. Let's turn to the bond market. Yields look like this at the front end of the curve. The 2-year down 2 basis points. Last week, yields falling for a third consecutive week. We haven't seen week 4 for a long time. In fact, I don't think you had a 4-week streak of yields falling at the front end of the curve through the whole of 2024. This run's quite impressive given what we've seen in the run-up to it.
And some people might say this is the opposite of a risk-on move, that basically if you have some losses in the stock market, it's logical to see some gains in the bond market. But this goes beyond that. It goes to the fact that there still is a cutting bias among some members of the Federal Reserve. There is disinflationary data. The JOLTS number came in a bit lower than expected. And then you have commentary from companies like Chipotle saying that after raising prices last year by 2%, they're not going to raise prices this year. And even with the tariffs, they have to be really careful before raising prices on consumers that don't have the same kind of tolerance for it.
This is the key point when it comes to the tariffs. This could be different. How quickly can they pass them on to consumers? Are we knocking on the door of the limit of consumer price tolerance? And if we are, and if companies have to take it on the margin and have to cut costs elsewhere, then you start to destabilise the labour market, and that can feed on itself. So this could have a bigger impact perhaps on demand and maybe not on inflation, which is where I think the market is slowly moving its focus to over the past few days.
The 10-year yield sniffing that out, declining on the idea of this being a disinflationary, degrowth type of measure rather than one that's just purely inflationary.
Let's turn from the bond market to foreign exchange. Let's check out FX together. I want to focus on dollar yen. We had some inflationary numbers out of Japan today. Wage growth. Look at this yen strength off the back of it. Dollar yen is down by 1 full percentage point. That is some yen strength on the prospect that the BOJ might be gearing up, might have to go and hike interest rates again.
What's fascinating is that this move was already in place because the dollar is generally weaker versus everything as people rethink just how quickly tariffs will go into effect. You're seeing that with the Canadian dollar, you're seeing that with the peso. With Japan, this just highlights how much they continue to diverge from the rest of the world and how far the yen has to go, which is the reason why you're seeing an increasing number of portfolio managers say they like the rest of the world just because the bar is so low and things are so low price.
That's the latest on Japan. Labour cash earnings year over year, 4.8% for December, much higher than expectations. At the surveillance this morning, President Donald Trump saying the United States should take control of the Gaza Strip and transform it into a Riviera. The PLO saying it's steadfast in opposing any displacement of Gazans from their homeland. Arab nations pushing back.
Basically saying this is exactly what we've been trying to avoid. This is their homeland. They want to go back. It goes against protocol. Before we get into the analysis of exactly what this looks like, I want to point out something that happened in 2018 when Donald Trump went to visit Kim Jong-un in North Korea to talk about denuclearization. And he started to say, look at this property on the beachfront. It would be fantastic as condos. It would be fantastic as hotels. And basically, he said, if Kim disagrees to take and give up his nuclear arsenal, he said, they have great beaches. You see that whenever they're exploding their cannons into the ocean, right? I said, boy, look at that view. Wouldn't that make a great condo?
He's a real estate developer. That's how he sees the world. It's not surprising, is it?
It's not surprising. What the U.S. does with this from policy, what this does to jumpstart negotiations, how offended a number of nations are, all of that we shall see. This is a playbook we've seen before from Donald Trump. He's a real estate developer.
We'll hear from an official from the administration a little bit later, sitting down with Annmarie. MH made this point at the top of the programme, and I think it's a good point to make, that this proposal might seem out there, but perhaps it will inspire proposals from elsewhere. Because at the moment, there aren't too many.
At a time when there is complete rubble in the Gaza Strip, and there are 2.2 million people who want to find their homes, and their homes may not exist, probably don't. How do you even rebuild while also providing services to people in a demolition zone? That is a viable question, and so far there have not been solutions.
With great difficulty. That's the latest news on that front. Let's turn to China, weighing a probe into Apple's policies. Sources telling Bloomberg the country's antitrust watchdog is examining the fees it charges app developers, which include taking a cut of up to 30% on in-app spending. Apple declining in the pre-market.
This inquiry began last year. Unclear how much this has to do with Trump and how much there is an arsenal of tools that China has been developing to go after U.S. companies, particularly those that are in direct competition with their national champions. To me, this just highlights how much they are watching this space, and they have been for a long time, and that this could get ugly, and why it's a potential liability to an increasing number of global companies from the U.S. that do business in China. That is what I'm listening to for earnings calls.
This goes beyond just tariffs. Some of these companies are literally the poster child for American commerce, corporate America. We'll catch up with one of them a little bit later. We'll catch up with the Walt Disney Company. We'll speak to the Disney CFO, Hugh Johnston. I think that's an important question to ask. How are you dealing with this tension? You're one of the flag bearers. The definition of America Inc. Are you seeing any pushback at all? Are you worried about any pushback coming down the line?
Especially because a lot of the resorts over in Asia, in China, have done really well. Have they seen people pull back from some of those experiences because they're less than pleased with the American situation?
Let's turn to the latest earnings. We'll talk about Disney a little bit later. Alphabet delivering disappointing fourth quarter results. Revenue missing expectations due to slowing growth in its cloud business. The company also projecting much higher than forecast capital expenditures for 2025. The stock is down by 7%. They're increasing capex by about the same amount as Meta increased capex. The difference is they've got a slowdown in revenue in one of the core parts of the business. And I think that's what gets people attention. You can spend more, sure, but you've got to show that the money is coming with it.
And where are they spending it? They are expecting to spend $75 billion this year in capital expenditures. The expectation on the street was $57.9 billion. That is a huge delta at a time where they say this is directly driving revenue to get cloud consumers into our company. That said, they are number 3 in the cloud computing space, and they have not seen the same type of growth in sales that a lot of people were expecting. People are losing patience. We were wondering whether that would happen. We are seeing it in the numbers.
It's happening selectively. It's happening with this name. It's down by 7% in early trading. Let's stick with Alphabet. Stefan Slowinski of BNP Paribas Exane keeping an outperform rating on the shares and a 225 price target. Stefan joins us now for more. Stefan, welcome back to the programme. It's good to see you as
Thanks,
always.
Jonathan.
Just your first take on the numbers. What do you make of that?
Yeah, I think overall the search business, YouTube actually beat expectations. Search beat by 150 basis points, YouTube by 270 basis points, so healthy advertising. But as you pointed out, it's kind of those other businesses, Google Cloud, miss. Just like Azure, they're seeing capacity constraints. It's not a problem around demand. You know, large commitments are up 2x year over year. So we did see, cloud miss. We did see the devices business pulled forward some business into Q3. So the kind of non-advertising businesses were a little bit weaker than expected. Ironically, Google's being punished for its success in diversification. You know, if 25% of revenues coming from non-advertising, from enterprise cloud, from subscriptions. But that's where we saw a little bit of weakness. And then you mentioned the CapEx, $75 billion. To put that into perspective, though, that's, quote, only 19% of revenues. When you look at Meta's CapEx, that's 37% of revenues they're expected to spend. So it is still a more minimal amount for Google relative to its size.
But Stefan, Meta positioned it in a different way. You heard about them driving efficiencies, creating more profitability in their advertising by giving their customers a better proposition in terms of directly targeting potential consumers. Why was Google unable to give that type of promise of application of some of these tools that Meta did?
I think you have a communication issue at Google, which you have had for many years. The company does not give guidance. It does not quantify the impacts, either potentially negative or positively, of one-offs or of longer-term investments. But again, when you look at the numbers, the advertising business beating expectations. When you look at AI overviews, the sort of Gen AI-powered search is now in 100 different countries, and they're now saying that the monetization of that is at least on par with traditional search. When you look at the ability to take pictures to search, 20 billion of those are being done every single month. And when you look at Circle to search, of the people who are using that, they're using that for 10% of all searches. So, Google definitely is being successful in innovating within search. And it's also being very successful in innovating using AI beyond search. Look at Waymo, look at YouTube, which is just crushing it in the US. But they don't articulate that very well. And that continues to hold back the multiple people are willing to pay for the stock.
In the meantime, Stefan, the narrative is moving on. It seems as if people are saying last year was the year of big tech and the cloud providers, and this will be the year of the adopters. And Meta made a good story about why they were an adopter. Do you think that story is premature? that people are short-sighted when it comes to how much more spending has to go into cloud computing at a time where demand is still far outstripping how much supply there is?
When you look at what Microsoft said, what Meta said, what Google said, they are having to deliver on a huge amount of demand. Microsoft has a backlog, a commitment of $300 billion. Meta has 3.3 billion daily active users that it wants using Meta AI. And Google already has 7 applications with 2 billion people each that are now being powered by Gemini. So we are seeing widespread adoption. We're starting to see monetization. Microsoft's $13 billion AI run rate. As I mentioned with Google, we're seeing them monetize AI overviews at least at the same rate as core search. So, they're having to invest to deliver on that demand is there. Obviously, there's been a lot of talk about DeepSeek, and innovations like that will help, but there's still a massive amount of build that needs to be done to meet that demand that's in the market already.
Stefan, just getting some earnings from elsewhere, just to share it with our audience very quickly. Disney coming out with a beat. First quarter adjusted EPS 176, the estimate 142. Just a first look. An upside surprise, the stock is up by 2.5%, now 3 percentage points higher. I'll come back to that story in just a moment. Stefan, I just wanted to fit in one final question for you. Just want to squeeze this in. And I sound like a broken record because I keep bringing it up. When it comes to Tesla, all we talk about is full self-driving. Why don't we talk more about Waymo and Alphabet's stake in it? Just how big could that be for this company?
Yeah, again, it comes back to communication. So, Waymo has taken outside investment, which is the second time it's done that, which is a signal that maybe they will look to monetize that more aggressively. Last night, they talked about rolling that out in more U.S. cities, of course, in Japan as well. And it's another example of, how they continue to execute on using AI and using their software development skills to enter new areas. So, we continue to see that as an upside opportunity for Google over time. That said, within the multi-trillion-dollar market caps of these companies, it may still not be enough to kind of move the needle, but it should drive confidence and hopefully drive more of a multiple re-rating. When you look at Google's share price, it matches step for step the earnings growth. So on days like today, when it pulls back, communication's quite poor, but the stock will recover in line with the earnings growth. If they can communicate better on some of these opportunities, then maybe we eventually get multiple expansion.
Stefan, appreciate it, sir. Stefan's opinion, constructive on the stock. Stefan Slowinski there of BNP Paribas Exane. If you miss on certain segments of revenue, it's difficult because it will turn the attention to the spending. You turn your attention to the spending over at Alphabet and you come out with numbers like 75 billion when the market was looking for 57.9. Probably not in a good spot. And maybe you have got a communication problem. The stock is down by 7% in the pre-market. Should we get back to Disney, Bramo?
Sure.
First quarter adjusted EPS 176, the estimate 142.
What's interesting is when you look into the details, the experience revenue really outperformed $9.4 billion versus the estimate of $9.3 billion. They missed an entertainment revenue, but otherwise, this is a really positive look. I just wonder how vulnerable that is to some of the things that we were talking about, the international Disney footprint. Do they start to see some pushback if that also is viewed as Americana incarnate? That's something I'm very curious to have a conversation about.
Speaking on pushback, just on pricing, look at this headline. Sees the second quarter modest decline in Disney Plus subscribers quarter on quarter. Be interested to find out from Hugh Johnston. We catch up with the Disney CFO later on this morning, whether we're starting to see that pushback from consumers, whether we're reaching the limits of that tolerance around pricing. Interested to see what he's got to say or whether he thinks this recovers in the year ahead.
Especially because every other platform provider has been doing the same. So is there sort of a pick and choose process going on that you're seeing more broadly? And what are the products that continue to attract people to the platform, even at a higher price? Like Spotify, if you need to listen to music.
Did you upgrade yesterday?
I didn't know. I'm still listening to my podcasts. Right. It's just that, silence. It's like a Zen workout.
Okay. Disney's up by 1.4%. You are not Zen. Let's get you an update on stories elsewhere this morning. Far from it. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Unions representing federal workers are suing the Trump administration for its buyout offers. The unions argue the Office of Personnel Management lacked the legal authority to make the offers to employees to resign for months of full pay for little to no work. They also say workers received vague and contradictory information on their rights. Meanwhile, AMD shares are falling nearly 9% in the pre-market after the chipmaker gave a disappointing outlook for its data center business, while sales for the segment in the fourth quarter also came up short. The report renewed concern that AMD's push into AI equipment has lost momentum, and that overshadowed what were otherwise solid results. And a group of banks led by Morgan Stanley is set to increase the sale of loans tied to X. The banks aim to sell up to $5.5 billion of debt instead of the initial $3 billion. Sources say there's strong demand from investors betting that Elon Musk-linked companies like X may benefit from his relationship with President Trump. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, paying the price for trade uncertainty.
Ultimately, the stronger influence from this whole tariff war and tariff situation is the drag on growth. The kind of drop in yields, I think, now begins to reflect that longer-term negative impact on growth.
Up next on the program, we'll catch up with the brilliant Lindsay Rosner of Goldman Sachs Asset Management. Equity futures on the S&P negative by 0.5% after snapping a two-day slide in yesterday's session. We declined once again. In the bond market, yields lower by 3 basis points. The 10-year, a break of 450. Job openings coming in much lower than expected yesterday. Let's see if we get another read that speaks to a similar theme in the labour market later on this morning. 8:15 Eastern Time, we get the ADP jobs report. Under surveillance this morning, paying the price for trade uncertainty.
Ultimately, the stronger influence from this whole tariff war and tariff situation is the drag on growth. The kind of drop in yields, I think, now begins to reflect that longer-term negative impact on growth from longer-term sustained tariff policy, not from these, 25, 50% that get reversed quickly, but more the sustained story in tariffs, which is what we're expecting.
So here's the latest this morning. US traders weighing the risks of possible tariffs with more labour data on deck. Lindsay Rosner of Goldman Sachs writing, December's duration sell-off was an opportunity, and we continue to think fixed income is a good part of the portfolio. Lindsay joins us now for more. Lindsay, good morning. It's good to see you.
Thank you. Good to see you too.
Let's start with the tariffs and the price of all of this uncertainty. Does it raise the hurdle for rate cuts at the Federal Reserve?
It's certainly going to affect the data, and it does raise the hurdle. But I think you got to be honest about how very little is priced in. We've got 45 basis points priced in between now and the end of the year in terms of cuts. I think there's not that much that can happen in the labor market, and we can talk about that more. Inflation seems to be the question, and it really appears so far that tariffs are a tool, and they're a tool for negotiation, and they maybe don't have the staying power that people were probably worried about one day into the tariff announcement.
There's some debate about what the tariffs could mean for growth and for inflation. Lisa and I have been talking about this through the week. We had a bit of a stress test on Monday morning. So we had the prospect of 25% tariffs on two of the biggest trading partners of America, and we saw yields drop initially at the long end on a 10-year. Did you and the team take any signal from that? What did that tell you about where the market was focusing?
Right. Well, you had the twist flattening, right? So you had the front end go a little bit higher. The idea there is that, to your point, the Fed wouldn't be able to cut. But remember, it was just a handful of basis points. Back-end yields did go lower, and the idea there was the probability of recession had increased. Tariffs are definitely growth reducing. But again, we're talking in general terms of what tariffs do. Right now, they aren't in place. And so I think we need to all take a little bit of a breather. And I don't disagree. I think it's been a stress test for all of our hearts over the past few days. But take a little bit of a breather and understand that these are tools. And I think you see the result of 10,000 troops on the border to help shows that they're kind of working.
From the corporate executives, the CFOs who you talk to who are looking to finance themselves, how do they take a breather at a time where they have to come up with plans? How long can they take a breather? Do you get a sense that this is filtering into the decisions of when to start raising money in 2025 or how they can really plan ahead?
Well, luckily, we don't have a wall of maturity, right? That's always been the biggest fear on debt since the financial crisis. Is there a wall of maturity where these companies have to act and they have to act now? They've done a really good job. I think this is kind of the PTSD of the financial crisis, to never put yourself in a position that you are forced to come to market at a specific time or else. So I think companies have set themselves up in a really good way. They have cash balances, they have healthy balance sheets, but certainly uncertainty is not a good thing when you're a management team trying to predict for the future. We get a lot of data right now in terms of management speak, and so far we're not seeing from a guide perspective tremendously reduced confidence. Now, all of this stuff on tariffs and what's happening is fresh and new. So it's hard to completely get that into your philosophy of how you want to finance yourself going forward. But the markets are wide open for financing. I think you just mentioned right before the break that X is upping their deal from 3 to 5. There is appetite and the markets are wide open. So I think right now it is business as usual, but maybe a little bit of a bird on the shoulder of uncertainty and concern.
As an investor, does that bird on the shoulder prompt you to say maybe there's a little bit too price to perfection type of valuation in the credit market, especially if long-term yields are falling for the wrong reasons? The idea of reduced long-term growth propositions.
So we think from the spread perspective, what's happening in credit markets, that spreads are supported. And why they're supported is because the economy is really strong. And we saw that when we got our finalized print on GDP for the last quarter. We're seeing it in terms of consumption numbers. We are not seeing a dip tremendously in confidence right now with everything going on. In particular, we think the U.S. economy is really strong, and it's really strong relative to the rest of the world. We think that continues, and that supports spreads even at these really tight valuations. On the other side of things, I think the macro is really where it's interesting, and that's what's been ping-ponging the most. If you look at credit hasn't moved that dramatically this year, a basis point or two in either direction. And in fact, historically, high yields has actually outperformed IG in the face of tariffs. So you would think actually the riskier stuff may be in a better position given what's happening. But on the macro side, there are a lot of opportunities. And what we've done is we've used this kind of knee-jerk reaction to policies to take advantage of getting our positions right-sized.
Why did you think the sell-off in duration was overdone in December? Why did you think that backup in yields was overdone, out of interest?
It was overdone to us because it started to knock on the door of really significant real yields. We lived for a really long time, remember, ZIRP and zero interest rate. In that whole world, there really wasn't real yields in the curve. What happened in December in that backup and part of unwinding of a prior trade was that we started to get real yield put into the curve. And we talked to a ton of clients daily, particularly pensions, and they're thirsting for real yield. And so when real yield's out there, this is a great opportunity. And we know that the idea of switching also from equities to fixed income really makes sense, and they'd be happy about this.
It's so interesting. It's not just about this move becoming self-limiting because it could damage growth. There's just a wall of money out there looking for that number.
Yeah, I think that's true. And again, we all stare at these. I feel like we're on money market watch. We're staring at how many assets are in money markets and when they are actually going to move. I think we're really at a time where it's starting to make sense, and unlocking real yield is really convincing.
Lindsay, always smart, always a clinic. Appreciate your time. Thank you. Lindsay Rosner there of Goldman Sachs Asset Management. Yields have backed away since then, much, much lower.
At a time when people are looking at the potential disinflationary impact of tariffs, on a broader level, people are worried that maybe they got a little over their skis with the idea of rate hikes this year, especially as the Fed seems to still talk about a rate-cutting paradigm down the path. Maybe not there now, but still down the line.
There's a bias to cut. I totally agree with you. There's still a bias to cut at the Federal Reserve. It's just about whether these policy changes, if we do get those changes, whether they constrain that bias, and we'll see.
Or whether they delay them that much further, which potentially could constrain longer-end yields on the growth side.
Up next on the programme, at the second hour of Bloomberg Surveillance, Tom Becker of BlackRock, Middle East envoy, Morgan Ortagus, the Disney CFO, Hugh Johnston, and the Richmond Fed President, Tom Barkin. Look out for that in the second hour of Bloomberg Surveillance. Up next.
The exceptionalism is still firmly in place, but the fundamentals underpinning this exceptionalism are at risk.
Almost all of the policies that we've heard floated from Washington do have an inflationary element, but markets will care less about that if it comes with a side of growth.
The fog now is so dense in terms of what this is going to mean for business capex, what this is going to mean for inflation.
Fed cuts get kind of pushed out when you see these tariff increases get implemented.
This sort of gives them cover not to do very much for some period of time as they sort out what's going on.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures declining 0.5% on the S&P 500. On the Nasdaq 100, we're negative by 0.8. Front and center, bit of tension between the United States and China, captured by a couple of stocks. Let's start with Apple. According to Bloomberg reporting, China's antitrust watchdog laying the groundwork for a potential probe into the company's policies and the fees it charges app developers. That stock is down by 2.5% in China. Pressure on Alibaba, on JD.com, as the US Postal Services temporarily suspend inbound international packages from, guess where? China and Hong Kong.
This highlights how much businesses are actually seeing a serious effect from some of the tit for tat that's ongoing. Unclear how much of this Apple investigation is tied to that. You can imagine, as you said before, that it has not evaded the notice of the Chinese authorities that certain companies are the darlings of America and that maybe they want to de-emphasize their presence when it comes to the United States Postal Service. They came out and they said, how do we even understand how to put into effect this de minimis tariff concept on packages coming from China, coming from Hong Kong, now under the value of $800 are no longer exempt. We don't even know how to put that into effect, so we're just not going to do it. And that seems to be their path of travel.
That's the problem with tariffs sometimes, even if it's not meant to hurt you. If you don't know what to do, you want to stay on the right side of the law, you do nothing, right? And that hurts economic activity to some extent.
That's the reason why you see Temu and Shein and some of these packages. I mean, if you've ordered a T-shirt for $6 from Shein and you're waiting on it, you're going to be waiting a little bit longer, because how does the United States Postal Service know that that's going to be okay, or how much to even charge, who to charge it? This is the uncertainty that can have a blanketing effect on some activity.
It's a super complex moment. We need to talk about the earnings as well. The latest from Alphabet overnight, the stock declining. I'm sure you saw that after the close in yesterday's session. We're down by 7% this morning so far in the pre-market. CapEx was huge, $75 billion for 2025. The estimate was 57.9. That was already a big number. Cloud revenue slowing as well. That's just going to put even more attention on the spend.
The fact that they aren't necessarily selling at the pace that many people were expecting, and they are solidly number 3 when it comes to the cloud computing platforms. Stefan Slowinski, BNP Paribas, was saying that it's just a messaging issue, and that Sundar Pichai should maybe put on his leather jacket, come out there and say, we are investing the $75 billion, not the $57.9 billion, because we are planning to use AI in every facet of our advertising, in every facet of our existence, and we're going to monetize this and develop all sorts of cool new things, and then the profits would be, then the stock would be up. This just highlights the narrative and how much the narrative shift is driving so much of the post-market
It's interesting you suggest they could take a lesson from NVIDIA. I would agree with you. I think they could also take a lesson from Tesla. The storytelling from Tesla is so powerful. All the analysts come on the program, they talk about full self-driving. You've got to think beyond just selling vehicles. There's Alphabet with a huge stake in Waymo, and Waymo's a massive part of that conversation. And Stefan mentioned this too. They've got to get better at communicating that story.
Waymo is actually delivering ride services around the world. They've been piloting a whole host of different things. That said, the revenues from other bets, including Waymo, is $400 billion versus the more than 500 that people were expecting. So maybe they want to de-emphasize that. But you're right. Where is that storytelling? You can ride anywhere. You can see grandma. Grandma can come to you, and she doesn't even get behind a wheel. You know?
Don't need a license.
Exactly.
Don't need a car. Sounds perfect. Stock is down by 7%. Got some earnings a little bit early this morning. Got those numbers from the Walt Disney Company. They came out with an upside surprise. EPS for the first quarter, 176. The estimate, 142.
Yeah, it comes from the streaming and the fact that Moana 2 did really well. I saw that actually with my kids. I thought it wasn't as good as the first one, I just want to say, but that's enough of my review.
Good review.
They did see a decline in some of their streaming customers, although not as much as was expected on the street. Experiences coming in higher than expected. Disney around the world, Disney Paris, Disney Hong Kong. How much does that get hit at a time where the American story is being challenged on a couple of fronts?
More on Disney a little bit later, so look out for that. More data as well. Later on this morning, we'll get the ADP payrolls report. That comes at 8:15. So stay tuned for that. ISM services 10 a.m. That's a big data point. And some Fed speak later. Tom Barkin's coming up, so look out for that too. Coming up on the programme then, let's give you the full list. The Middle East envoy, Morgan Ortagus, on President Trump's plans for Gaza. The Disney CFO, Hugh Johnston, after the media giant beats expectations. And, as I said, the Richmond Fed President, Tom Barkin, on the policy uncertainty ahead. He joins us in about 40 minutes' time. We begin this hour with equities inching lower. Tom Becker of BlackRock writing this. With the news on tariffs, we see a high high bar for further Fed easing and a QT program that may continue for longer than expected, particularly as inflation appears to be settling closer to 3% than 2%. Tom joins us now for more. Tom, welcome to the program, sir. You made a really important change at the end of last year coming into 2025. When a lot of people were getting bulled up on US exceptionalism, you started to look elsewhere. Tom, just explain to us what you and the team did and why.
Sure, John. Hi, Lisa. Good to see you both. I think we still believe in the U.S. exceptionalism story on the growth fundamentals, on inflation as well. I think where it got priced into assets over the course of November and December is a little bit of where we took issue. So as we saw kind of, exuberance into U.S. equities and kind of the expectations rising so much, we saw that as an opportunity to look abroad to some unloved foreign equity markets. Markets in Europe, UK, Sweden, France even, where the expectations were quite low. And you also had some fundamentals maybe shifting in their favor with weaker exchange rates, more dovish central banks, more scope for easing. And so I think just separating kind of what's going on in the macro fundamentals versus what's priced and how investors are positioned can be really important in markets like this.
Tom, that absolutely won out when it came to the first month of this year. There seems to be a shift back to where we were before, where people are looking back to the United States, especially as tariff news starts to come out. Do you think this is a head fake, or do you think that this is the beginning of going back to the U.S. and selling all those stocks that you made out well with in January?
So I think structurally, as lots of people talk about, the U.S. earnings story is really strong. Our team's a tactical investment team, so that 1 to 2 quarter horizon, looking for mispricings. We have been pulling in a little bit of the U.S. equity underweight, but the news that you were just talking about in terms of, I took Waymo into the office this morning. It's a great service. The expectations are really there in a lot of the prices. Whereas in some of these foreign markets, we see kind of the composition of the indices also benefiting them. So a little more goods oriented. We're seeing kind of broad-based global commodities catch a little bit of a bid year to date. That's going to help some of these indices that have more exposure to energy, more exposure to goods, whereas the U.S. is a little bit more of a services-based index.
Tom, how much is the foreign bet predicated on the idea of the dollar continuing to strengthen? And it reduces the exporting power on some level, or the exporting attractiveness of the United States, and increases the exporting attractiveness of the places like Europe and Japan and even China.
I think that's a fundamental tension, Lisa. You've got a kind of the desire to have a weaker dollar, but U.S. exceptionalism on the nominal growth side, on the central bank policy side, on the fiscal side, really kind of keeping the dollar stronger and weighing on those foreign earnings that U.S. companies report. And so, as Q4 earnings kind of, come through in the coming weeks, I think the dollar strength also kind of U.S. real rates, U.S. Interest rates being a little bit higher, the wage bill being a little bit higher. We just got some news overnight in the ECB, wage expectations falling pretty sharply there. And so the economic exceptionalism might translate into slightly lower margins in the U.S., and so that's the tension there.
Tom, do you see that margin stress in big cap more than small cap?
So we play at the country level, and so we're much more U.S. versus foreign markets. That said, the S&P 500, the composition, the concentration, it has really shifted over the last year, and so that the U.S. is a mega cap index now, and so insofar as we go overweight some of these foreign markets, we do kind of start to take some size exposure in that, just because of how concentrated the U.S. index has gotten. We were looking kind of.
No, carry on, Tom, please.
Yeah, sure. Last year, looking at kind of some of the big macro risk days for the S&P 500, we can do this using kind of daily index equity derivatives. And three of the top 15 were NVIDIA earnings days. The other ones were the election, CPI days, Fed days, kind of these macro events that move kind of the whole real rate curve. And then you've got kind of NVIDIA earnings and kind of this whole AI ecosystem moving up in the rank ordering of kind of the risk for the entire S&P 500 index. It's definitely a more concentrated index.
Tom, just to jump in, speaking of dislocations, we've had one with NVIDIA. You mentioned the name. The stock is down by 21% in about a month or so, a little bit more than a month. Is that one of those dislocations you want to take a look at and say that's an opportunity, or is that one you stand back from and say this is sending a broader signal?
So, as I said, we've been trimming back the U.S. underweight as pricing has kind of moved in our favor. I think the NVIDIA story is one where maybe just the macro positives of kind of AI and productivity growth and all the things that are kind of driving U.S. exceptionalism, how big that moat is around the ability of earnings to kind of accrue to the leaders in this space. It just points to kind of some of the risk return when you have positioning so one-sided, and that's something we're very cognizant of in portfolios.
At the same time, when we take a look at performance, there's been one performance that continues and steadily has been the stellar one of the year. That has been gold. And I want to finish there, whether there's actually this tell in the gold market that we're seeing a record high. We're seeing gains of almost 10% so far this year. We're seeing gold gain, whether the dollar gains, whether the dollar loses, whether stocks gain, whether stocks are off. I'm just wondering whether that is a concern for you or whether that's an opportunity, what the signal is.
Yeah. I think market participants have been really looking for diversification. So we've had a number of years here post-pandemic when stocks and bonds have been much more correlated than they had been in the previous decades. That makes portfolio construction quite challenging. Kind of your ballast is moving up and down in the same way that kind of your growth equities are. And so I think gold is one of these examples of an asset class that investors look to zig when the other parts of their portfolio are zagging. And so I think that's one aspect of it. I think also just there's the larger kind of, worries about de-dollarization in the background, where people are looking for kind of hard assets. Gold's not the only commodity that's up year to date. And you've seen maybe a bottoming of some of the concerns about the slowdown in China, kind of moving kind of the broad commodity index higher. I think that tells you that global growth is still pretty resilient, and it's not just the U.S. that's kind of driving kind of activity globally. As we come into the year, PMI is kind of bottoming in Europe, looking a little firmer in Asia, and then the U.S.ism, quite strong. So I think there's kind of an industrial activity to all of this as well.
Tom, if someone were a conspiracy theorist, and I'm not, but I'm just throwing this out there because I see what people are doing on Twitter. Stop laughing at me.
We're both laughing.
Listen, Tom, I think there is this issue that people say, look, gold is up. The dollar is suddenly off now for 2 days because of tariffs, maybe not necessarily coming through as people expected. This is sort of one beginning step to people trying to diversify away from the dollar to your de-dollarization point. And you're going to see that grow throughout the year. And that could really challenge both the deficit story in the U.S., the American exceptionalism story. Another example of why you would want to be in other countries other than the United States. What would you say to those conspiracy theorists?
I think you can just look at the mechanics, Lisa. It's not just a conspiracy. Sort of global cap-weighted indices have the U.S. share of those has risen over time. Bond issuance is, a lot of the bond indices are issuance weighted as well. So the U.S. government issuing more debt than foreign markets has meant that investors have taken on more treasuries and U.S. debt as well. And so I think, you point to kind of, investors looking for alternatives because I think mechanically they've gained exposure over time. What we do is we look at kind of those 25 plus countries that are liquid and where we can measure the macro, the growth, the inflation, the monetary policy sentiment, and try to discern where is there maybe a little bit of an opportunity over the next 1 or 2 quarters. That next central bank that might be a little more dovish on the bond side or on the earnings side, where is positioning maybe a little bit too negative, but there's some green shoots on the growth fundamentals.
Hey, Tom, this was smart. Let's do it again soon. Tom Becker there of BlackRock on the latest. What a call coming into 2025 to go underweight US equities versus the rest of the world, particularly places like Europe at a time when people were so bulled up on the US equity market. And just a hint there, we're closing that underweight slowly. As we talk about NVIDIA, they're not going to do single names, but maybe taking advantage of some of the dislocations we've seen over the past few weeks.
I wrote this down. Trimming back or underweight. I need to use language like that at home. It's the most sort of passive and kind way of saying we're buying.
It's how to dance around it, right?
It's well, beautifully done. I mean, look, how many people are viewing this market as a tactical market where you can't have longer-term calls, where views are your enemies, and just sort of having a look at measures and being really methodical about, certain trigger points where you're going to buy? That's kind of the strategy for the year. Because how can anyone have a concrete view at a time where we have no idea what's going to happen in 2 hours' time?
Yeah, making a trade in Europe is very different to making an investment. I think, is it Mike Platt who says that an investment is a trade gone wrong? Something like that. Particularly in Europe, that feels that way over the past few years.
At this moment, it is hard to know when you don't have governments in some of the biggest economies in Europe.
Yeah.
That's a fundamental issue. At the same time, people saying, well, the ECB has to cut more, so just follow the money there.
Equities this morning, negative by 0.5% stateside. The outperformance in Europe for the month of January, at least, phenomenal. Euro Stoxx 50 was up by something like 8%. Whether you think there are some sustainable tailwinds to that outperformance is a completely different conversation. Let's give an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hecker. Say, Yahara.
Hi, John. Disney shares are rising 1.4% in the pre-market. The company reporting robust first quarter results led by its blockbuster films Moana 2 and Mufasa. Streaming also did well amid price hikes, achieving a third straight quarter of profitability. Those gains offsetting what was a tough quarter for Disney's TV networks and its theme parks. Meanwhile, President Donald Trump said he wants Iran to be great and successful, but it cannot have a nuclear weapon. Trump posted to Truth Social earlier this morning that he prefers a verified nuclear peace agreement. The post comes after the president signed a directive to raise economic pressure on Iran through sanctions and tougher enforcement. And the U.S. Treasury Department says Elon Musk's government efficiency team has been given read-only access to coded data of the government's payment system. However, at least one team member has been given top-secret security clearance. Democratic lawmakers had raised concerns about the system's integrity due to access by Musk's team. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, Trump's vision for Gaza.
The U.S. will take over the Gaza Strip, and we will do a job with it, too. I don't want to be cute. I don't want to be a wise guy, but the Riviera of the Middle East.
That conversation up next, live from New York this morning. Good morning. Equity futures negative by 0.5% on the S&P 500. The drag coming from Apple, the drag coming from Alphabet. Bond yields are lower by 4 basis points. The 10-year 4.47. Later on this morning, some important economic data. The ADP jobs report, the appetizer for the big one on Friday. The important piece, and I'm not calling the ADP report important, don't worry. The important piece is ISM services that comes a little bit later. I like the ADP report, but you know how people feel about it. They have mixed feelings going into payrolls.
I'm actually really interested in the ADP report because yesterday the JOLTS data came out and people said, you know what, we think it's fudged, we think it's wrong, we're looking at Indeed. So people are looking at other sources of data because they're not necessarily looking at the government data and saying that it's 100% accurate. But I agree. ISM services, does that continue? That might be the focus.
That's the more important data point later on this morning. Diplomatic enough?
That was
okay.
Sort of.
Good. All right.
We'll discuss.
Let's talk about diplomacy. Under surveillance this morning.
Very good.
Trump's vision for Gaza.
The U.S. will take over the Gaza Strip, and we will do a job with it, too. We'll own it and be responsible for dismantling all of the dangerous unexploded bombs and other weapons on the site, level the site and get rid of the destroyed buildings, level it out, create an economic development that will supply unlimited numbers of jobs and housing for the people of the area. I don't want to be cute. I don't want to be a wise guy, but the Riviera of the Middle East, this could be something that could be so bad. This could be so magnificent.
So here's the latest this morning. President Trump's proposal to take over the Gaza Strip sparking sharp opposition from Palestinian and other Arab officials. But the Israeli Prime Minister Netanyahu saying it could change history. Annmarie joins us now from Washington, D.C. Annmarie, just share the various reactions that we've had over the past 12 hours in response to those comments.
Well, Jonathan, as you said, this is really a welcome signal from the Israelis, and you're seeing a lot of Israelis welcome this as a bold movement that could be historic. We heard that from Netanyahu and other members of his government. But then, of course, there was swift responses against this. A lot of pushback coming from all over the Arab world, especially Saudi Arabia. Within moments of this press conference, the Saudis put out a statement once again reiterating that they want to see an independent Palestinian state. They say they are unwavering on this independent Palestinian state, and they say there will be no normalization with Israel if there isn't an independent Palestinian state. So Trump has this unorthodox, potentially bold vision, but fill in the gaps. How actually could this happen? And if the Arab world is against this, then it undermines the long-term goal he has for the region, which is to expand his Abraham Accords.
Annmarie, there's also this idea that maybe he wants to shock and awe with some proposal that seems outrageous to get people to the discussion table and get something that could be feasible. How realistic is this particular proposal in doing that, given some of the emotions tied around this issue and tied around, in particular, the Gaza Strip?
It's a great point, because we have seen Trump time and time again come out with these maximalist shock and awe approaches. Adversaries are going to say this is a sheer land grab by the United States, but it will spark debate. And at the moment, I'm not seeing anyone else really put forward a feasible plan for Gaza. So potentially that means others will try to fill the void and have this debate with the president. The fact of the matter is, the neighboring partners like Egypt and Jordan have already said and will be very reluctant to take in any more Palestinian refugees. And I don't see any other Arab countries in the region doing so as well. So already this is going to be incredibly complicated if these plans are serious.
Annmarie, it was interesting to see how the Israeli Prime Minister responded to those comments, because in some ways I wonder if he was quite relieved, because those comments took the heat off him pretty quickly. I didn't hear many pointed questions going his way at all.
Absolutely. He got off pretty easy, I would say, from the press, because everyone was so focused on what Trump just said in this shock and awe moment about Gaza. Even though he's flirted with this idea in the past, it seemed very serious last night, and he kept coming back to it, that no one was questioning Netanyahu and whether or not he would agree to a two-state solution, and whether or not, if this was to be a real solution from Trump, if that would mean Gaza would then go back to the Palestinian authorities. We have not heard about whether or not the UN would be involved in this, the PA. And then I would say Netanyahu didn't give a clear answer on where they are in talks of phase 2 of the ceasefire agreements, which we know those talks are being handled right now. And this is incredibly complicated for his government.
That news conference overshadowed by just a handful of comments. Annmarie, it's good to hear from you. As always, we'll catch up with AMH a little bit later. Coming up on this programme, we need to talk Disney. The CFO, Hugh Johnston, joins us following the company's better-than-expected first-quarter results. That conversation just around the corner. Up next. Stocks are lower here. We're down by 0.5% on the S&P. We're negative by 0.8 on the Nasdaq 100. Let's get you some movers this morning. Your morning movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. This is the 5th worst trading day response by Alphabet. They've wiped off $200 billion in market cap. When it comes down to the message on the cloud, we miss. We miss by a small amount, but that's not good enough for this market. So they join Google joins Microsoft with that AI miss. Why did they miss? Because they've got a capacity constraint. Demand, the CFO told the market. CFO says demand is more than we had available. We're or who is winning that market share. They're sticking to the gun, $75 billion in capex, and of course that's more than the market anticipated. That's got an impact on free cash flow. Roll it forward, have a look at AMD. Again, this comes down to what's your guidance. Strong double digits, that's not enough. Revenue up 69% on the data center business. That's not enough. They're promising the back end of the year is when you will see the promises come true. Just to put it in context, their AI chip business is $5 billion. NVIDIA, it's $100 billion. Hence the reason why if you're back-ending your guidance, they're back-ending the stock. Disney, you're going to have a conversation with the CFO in just a few moments. We're at a 2-month high, just off a 2-month high. Moana 2 seems to boost on one side of the movie side. But the studios, Disney Plus and Hulu, just under $11 billion in revenue. That's up 9%. BI have run the numbers. They say it looks stable. It lends credence to the strong operating momentum, and for them, it is a blockbuster at the box office. Jonathan.
Manus Cranny, thank you, sir. Disney positive by 0.5%. Under surveillance this morning, President Trump saying the US should take control of the Gaza Strip in comments alongside Israeli Prime Minister Benjamin Netanyahu. The suggestion drawing sharp criticism from Arab leaders. Elsewhere, the US Postal Service is temporarily suspending inbound packages from China and Hong Kong. The move threatening to delay shipments from retailers like Shein and Temu. The change coming after Trump revoked the de minimis rule, allowing packages under $800 to enter the country duty-free. And finally, more than 20,000 federal workers taking the Trump administration's buyout. Workers will continue to be paid through the end of September, the number expected to climb ahead of Thursday's deadline to take the deal. President Trump and Elon Musk are hoping to cut 10% of the federal workforce. We'll talk more about that a little bit later. Let's turn to the earnings and focus on Disney. The company's first quarter earnings topping estimates, fueled by success in its movie studios and streaming business. The stock is positive, and joining us now is the Disney CFO, Hugh Johnston. Hugh, welcome back to the programme, sir. We'll talk about how solid these numbers are in just a moment. There's one headline that Lisa and me were talking about a little bit earlier this morning. We'd love an explanation from you on it. Just seeing a second quarter modest decline in Disney Plus subscribers quarter on quarter. Hugh, could you explain that? Are we testing the limit of price tolerance of consumers? What's going on there?
Good morning, Jonathan. No, I don't think so at all, actually. That's really sort of more seasonal decline than anything else. Year over year will certainly be up, so certainly not concerned from that perspective. More broadly, the streaming business is doing extremely well. This is a business we invested pretty heavily in a couple of years ago. And what you're seeing now is the benefit of those investments. Our expectation is we'll continue to grow subs. We'll improve margins. We should make more than $1 billion in that business this year, and next year we're looking at double-digit margins in that business. So certainly a ton of positive momentum. Now you get into the question of why. A lot of it is the great content that's coming from the studio side of the house, both on the TV and the movie side of our entertainment business. Moana 2, Inside Out 2, Deadpool, all terrific hits. And on the TV side, the combination of Abbott Elementary, Shogun, and High Potential, causing viewership to grow. We're seeing higher engagement. We're seeing churn ultimately coming down over the course of this year. So we feel like the streaming business is going to be one of the big drivers for our company going forward.
Hugh, you know how much I love Shogun, and Lisa, I can say, loved Moana 2 as well. So the content slate is looking pretty good so far. I did want to talk about the cost issue, though, and clearly not an issue from you, so I appreciate the explanation. Conversation we've had over the last few days or so is if we get tariffs, can companies pass on the costs? I'd like to know from your perspective and for the company, the additional tariffs that have gone on to China, how that could impact your business. How are you thinking about things?
Yeah, right now, based on what's been proposed, and obviously this is a rapidly evolving environment, so we're going to react as we learn things. The impact would be immaterial to us. So from that perspective, really, the Walt Disney Company will be fine based on what's on the table right now.
At the same time, there's a question about the American brand at a time when there are increasing tensions between the U.S. and China, the U.S. and Europe. Given the fact that the experiences side of your business has been such a driver of growth for you, are you concerned? Have you seen any pullback in attendance in some of the areas like Shanghai, like France, like Paris, that could potentially have some feelings around the negotiations?
No, broadly speaking, the international parks business did very well. Profitability was up 28% for the quarter. Attendance, broadly speaking, was up. So from that perspective, we certainly feel good. Disneyland Paris actually had a terrific quarter. So feeling positive in that regard. Candidly, in many ways, what the Walt Disney Company represents is an opportunity to get away from all of the things that are happening in the world, right? Our job is to basically bring families joy, bring them together, give them smiles. So I think in many ways we're not a part of that conversation.
At the same time, and it's sort of pulling together the idea of experiences and the smiles and the streaming business, the idea that how much are people willing to pay for this? John was alluding to that with tariffs, but just more broadly, how much are you seeing consumers push back against some of the price increases, whether it's at the parks or whether it's at the streaming services, just simply because of how much prices have already gone up?
Yeah, we're not, to be perfectly candid. And I think it's always important to remember, from a consumer perspective, price is what you pay and value is what you get. And if you deliver sufficient value to the consumer, they are willing to pay the price. And I see that you see that going on broadly with companies these days. Companies that deliver a lot of value, their pricing is being accepted by consumers. And if you look at the value of a Disney vacation, if you look at the value of all the things that we're able to deliver on the streaming service, people are willing to pay the price for that because, frankly, they're getting a lot for it. So we haven't seen pushback really in a material way at all in that regard.
Hugh, speaking of the streaming business, can we talk about Hulu just a little bit more? Where are we with the negotiations with Comcast? Are we making any progress?
We're still in the process, and I probably won't go any further than that. I'd expect we'll get some resolution sometime.
What's holding things up, Hugh? What are the sticking points?
Oh, it's, I think, just the usual. People have different points of view on the value of the asset, so nothing more than that.
There is a content question here, Hugh, about what the driver of growth is going to be from a streaming perspective, whether it's instrumental in getting involved in some of the sports world or whether you can kind of lean into existing brands, how you do content creation at a time when there is a lot of question around what exactly sells other than the legacy brands.
Yeah, I think when you look at the Walt Disney Company, in many ways, we're best positioned from the standpoint of streaming because we do generate so much of our own content relative to some of our competitors. The way, in many ways, to think about Disney Plus is it really can be the portal into all things Disney and something you might want to have on 24 hours a day, 7 days a week, because if you want news, you'll be able to find it through Disney Plus Hulu. If you want sports, the ESPN tile just went on Disney Plus. If you want movie entertainment, TV entertainment, obviously with all of our studios, we generate a tremendous amount of entertainment from our own IP. So I think more than most, we're actually very well positioned to ascertain what the right level of content is and to create that content for ourselves, which obviously gives us some inherent advantages.
If we were talking 6 months ago, we might have started the conversation on artificial intelligence and how much you were using that in your content creation at a time where that's increasingly something that's being done. How much have you explored that to lower costs, expedite the process of time to get some of the movies and videos online?
We've got a number of use cases really across the entire company, from the ability to create content to the ability to manage the company more efficiently to the ability to manage our guest experiences inside the parks and cruise business. So we're in the early days of leveraging all that, as are most companies, because we really are very much in the early days of artificial intelligence, generally speaking. But we're experimenting a lot to try to understand where it can actually best add value to the Walt Disney Company.
Hugh, do you see a shift in vibes in this country where the kind of content that people want to view is changing?
Not really. It tends to be, I think, more based on age demographics than anything else. But by and large, if you look at what we're able to deliver by virtue of the broad base of IP that we have sort of the very traditional things from the original Walt Disney Company right through to things that come out of Marvel, that come out of Pixar, that are sort of very current and contemporary. So I don't see dramatic shifts going on by any stretch of the imagination. And I do see our assets actually appealing to a wide array of consumers.
Hugh, I know you've got to run. We appreciate your time. As always, sir, thank you. The Disney CFO, Hugh Johnston. A few points in that conversation. I want to pick out one of them, just on price, because this is important for the broader macro story at the moment. Are we seeing limits to consumer price tolerance? When we saw that headline initially about maybe a modest decline in subs in the second quarter for Disney+, some pushback there from Hugh, that maybe it's just seasonal and this will pick back up again.
And in fairness, the Street expected the decline to be much more significant, so maybe some credence there. There is a larger question, though, about whether people are going to start looking at the list of services that they have and canceling them, given how much they've all gone up. He started talking about value, and we hear that word a lot, where people say consumers are willing to pay the price for value. The concept of that is a very interesting one to me. Chipotle, for example, came out and doesn't want to raise prices because they want to remain the best in the value proposition space. It just becomes fudgy here about how much there is pushback from consumers and what that means, given that families spend quite a bit on those tickets to Disneyland.
Not too worried about tariffs, not too worried about pushback, not too worried about backlash against corporate America either. You knew where I was going with the content question at the end, right?
Of course I did.
Yeah, people are watching things like Landman on Paramount, moving away from maybe the stuff that would be considered woke a number of years ago.
Yeah, he said that he hasn't really noticed any big response. And I noticed that you said that I was a huge Moana 2 fan. And I just want to say, for the record, in case you missed it the first time.
Trying to keep you out of trouble.
Just to be very clear, and I could have told him this too, Moana 2 is not as good as Moana 1.
You should have told him.
And, well, I could have. You didn't actually give me any opportunity.
I didn't realise we wanted to be that harsh.
Well, I mean, that would have been a really hard interview. But I guess what I was trying to get at was all of the successful movies, Inside Out 2,
sure.
Moana 2, Marvel 3,
5, 6, 7, 8, 9, 10.
It's just sort of like, at what point do we have sort of new concepts that come to the fore that have traction that can actually get people to the box office?
Mike Wirth of Chevron is with us a little bit later, right, 20 minutes away. First question, has he watched Landman? And does he have to deal with the cartels on a regular basis in the south of this country? How accurate was that portrayal?
I'm just getting word that he just cancelled.
We'll find out. We'll see if he's watched
Hopefully.
it. I'd love to know how accurate it might be. Away from the cartels. Equity futures right now on the S&P 500, negative by 0.4%, with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Uber shares are falling some 5.4% in the pre-market after reporting weaker than expected fourth quarter earnings. This overshadowing an 18% year-over-year increase in bookings. Uber also announcing it set up a wait list for customers in Austin to request a driverless Waymo vehicle ahead of a planned launch later this year. A group of banks led by Morgan Stanley is set to increase a sale of loans tied to Elon Musk's social media platform X. The banks aim to sell up to $5.5 billion of debt instead of the initial $3 billion. Sources say there's strong demand from investors, betting that Musk-linked businesses may benefit from his relationship with President Trump. And Waffle House announcing it will put a 50-cent per egg surcharge on meals at its more than 2,000 locations. The move comes as egg prices in the U.S. skyrocket due to bird flu. According to the USDA, egg prices are expected to increase about 20% this year. That's your Bloomberg brief. John?
Yahara, thank you. I'm hearing that people are struggling to find eggs. Have you heard that? Yeah.
Have you seen the pictures of egg shortage?
I haven't found it difficult. I'm not going to tell you where I buy my eggs from now, just in case they start disappearing.
Like a personal secret?
My eggs are still there.
But they probably cost about $10.
I don't know how much they cost.
They definitely do not cost like $3. They used to cost $3.
No, they've gone up loads.
Right. They've gone up loads, but they probably already were expensive because they were the organic and
free range.
Free range.
No, sure,
they're given, a beautiful bed.
Absolutely.
They're petted.
I'm not a big drinker. I put food first.
So your eggs are probably $25.
No, I don't think they're that expensive. All right. I think they're like closer to 6 or 7 for like a big box.
Anyway, it's real. So if you're going to a store and you're saying, I want my egg sandwich, you might be getting liquid eggs rather than real eggs.
That's gross. Okay, but thanks for letting us know. Up next on the programme, the Fed's balancing act.
I continue to see a gradual reduction in the level of monetary policy restraint placed on the economy as we move towards a more neutral stance. I do not think we need to be in a hurry to change our stance. I will carefully assess the incoming data, the evolving outlook, and the balance of risk.
That conversation up next. Live from New York City, this is Bloomberg. Equity futures on the S&P 500 negative here by 0.4%. Data coming a little bit later, about 30 minutes away. The ADP jobs report, then ISM services later on. Going into that, yields are lower on a 10-year. We're down 5 basis points to 445.62. Under surveillance this morning, the Fed's balancing act.
I continue to see a gradual reduction in the level of monetary policy restraint placed on the economy as we move towards a more neutral stance as the most likely outcome. That said, I do not think we need to be in a hurry to change our stance. In considering additional adjustments to the federal funds rate, I will carefully assess the incoming data, the evolving outlook, and the balance of risk.
So here's the latest this morning. Traders bracing for economic data after Fed officials signal more clarity is needed on President Trump's economic plans. The Federal Reserve Bank of Richmond President Tom Barkin joins us now for more, alongside Bloomberg's Michael McKee. President Barkin, good to see you, sir. Great to catch up once again.
Happy to be back with you.
The first question we ask Fed officials these days is, did you include possible tariff changes in your outlook? So let's start there. Did you?
Well, so you're talking about forecasts we did in December.
Yeah.
That seems like a long time ago now, doesn't it?
A lifetime ago.
Yeah, no. So I think right now, if you look forward, you have to say tariffs are coming, are here, are going to be here. It's just incredibly hard to know exactly what it's going to be. So I think the concept of tariffs, sure, but the reality of what specific tariffs on what specific countries at what specific percent on what specific goods, we don't know.
The market seems to believe that on the margins, this just means the Fed is going to take its time, that you're going to take your time and assess all the data, including all the tariff announcements, and that you're not going to be in any rush and potentially may not cut it all this year. Do you agree that on the margins, the tariffs and the potential ramifications, the uncertainty would delay you from cutting rates?
Well, what I'm hearing from everyone I talk to is just elevated policy uncertainty. And you mentioned tariffs, but deregulation, where is it going to hit? Where's the tax plan going to come out? What's going to happen to net migration, energy policy, geopolitics? I think there's just a lot of uncertainty in the air, and it's very hard to know what's happening with growth and employment, what's happening with inflation, until you get a little more clarity on all of these uncertainties.
So what are companies telling you they're going to do now? Is everybody just sitting on their hands? What does this imply, the uncertainty imply for the economy?
So I think it's really interesting to look at these optimism indices. And if you go back to November and December, the Richmond Fed and the Atlanta Fed and Duke do a survey of CFOs. What you saw was total optimism on the economy went up significantly. New administration, climate for business, whatever. Optimism about your own company pretty much flatlined. And I think that's because people are dealing with this uncertainty. We think this will be good, but I don't know how it's going to play out in my business. Small business uncertainty had the biggest jump in, optimism had the biggest jump in its 40-year history, and then went up again last month. And I think small businesses are saying climate for business. Now, they do more of the hiring. The big businesses do more of the big investments. And so I think it's possible we may see another year like 2019, where consumers are spending and people are hiring, but investment sentiment is still a question mark. And that's what I'm looking to see.
Well, what's your kind of baseline for how you're going to judge the economy, given all of the uncertainty? You go into March 19th and you have to make a decision one way or the other. The default, I guess, would be to do nothing. But where do you think the economy is going to end up over the next 6 months while this cloud is over us?
Well, the case for wait and see is, in fact, that you want to wait and see. I mean, I start with a baseline economy the data's been pretty favorable. I mean, we had a pretty good growth in the fourth quarter. Consumer spending's healthy. Inflation, especially the last 2 months, has come down, and I expect the 12-month numbers to come down nicely over the next couple months as we lap last year's elevated first quarter numbers. Job market seems to have stabilized. So I start with a baseline that's pretty favorable for what we're trying to do. And then you have uncertainty, and it could take us up, it could take us down. We'll just have to see.
Do you still see the Fed cutting at some point this year?
I mean, that's certainly the lean, but we'll see what happens.
Could the Fed potentially see anything that could cause you to contemplate hiking rates?
Well, I never take anything off the table. And so if you never take anything off the table, you can't take anything off the table. So I'm not going to do that. But you'd have to see an economy overheating. And I don't see any signs of an economy overheating. I see inflation coming down, not going up. I see the job stabilizing, but we got the JOLTS data yesterday. It seemed to come down a little bit. It doesn't feel like we're overheating. And I think you'd have to imagine you're seeing an economy overheating.
Let me go back to the base case idea. At this point, do you think that interest rates are suitable for this economy? For a while, the Fed was saying we need to cut because we're still tight. But if you can't, is that okay? Are you looking for data that will tell you to cut, or are you looking for data that will tell you to hold?
Well, so I supported the recalibration we did, obviously, in the fall, and that's because with inflation in the twos and unemployment weakening at the time, the one number that seemed out of range was having the Fed funds rate at 5.3. So we've brought it down 100 basis points. It's at 4.3. I still think that's moderately restrictive, but we'll learn as we go. And if what happens is the economy comes back strong, you have to ask yourself questions about how restrictive you really are. If the economy weakens further, you can adjust appropriately. If inflation continues to come down, you could say, yep, I'm having the impact I want to have. If it doesn't, you ask yourself those questions. And so I think we've recalibrated to a place that is more sensible given, where the economy sits right now. And I think it leaves us well positioned on whatever happens.
But to go back to a very old Fed term, what would your bias be? Towards cutting?
My bias is to see what happens and then react appropriately. As I said, I think if you look at the last SEP, there's a lean in there, toward cutting. But let's see what happens.
That suggests you might be equally as open to hiking. Is that the case?
That's another good way to ask the exact same question. So I'm going to go, I think the lean is toward, but let's see what happens.
So you would be open to doing so?
As I said earlier,
I understand you don't want to make that headline this morning, but I just want to understand how open-minded you are on these issues.
I'm always open-minded on what happens with the data. If you see an economy that overheats, you have to respond to it. I don't see an economy yet close to overheating.
There was some questions about whether we are accommodative right now or restrictive. Can I just finish that? The Federal Reserve Chair, Jay Powell, I'm sure you watched the news conference, said that you were restrictive, then said financial conditions were accommodative. Can you square that circle at all?
Well, so I do think we're somewhat restrictive. I don't think we're hugely restrictive. We're a lot less restrictive, obviously, than we were, 6 months ago. But we'll see as we go. And like I said, if inflation continues to come down, that would be a positive sign. If the economy continues to, perform at a decent but not overheated level, that's a sign. But if you start seeing an economy, heat up, then you'd have to ask yourself those questions.
President Barkin, appreciate your time. As always, sir, thank you.
Good to be here.
The Federal Reserve Bank of Richmond President Tom Barkin there, alongside Bloomberg's Mike McKee. Up next on the programme, we'll catch up with the Chevron CEO Mike Wirth in just a moment. We'll speak to Pooja Sriram of Barclays and Congressman Jason Smith of Missouri. All of that and more at the third hour of Bloomberg Surveillance. Up next.
Exceptionalism is still firmly in place, but the fundamentals underpinning this exceptionalism are at risk.
Almost all of the policies that we've heard floated from Washington do have an inflationary element, but markets will care less about that if it comes with a side of growth.
The fog now is so dense in terms of what this is going to mean for business capex, what this is going to mean for inflation.
Fed cuts get kind of pushed out when you see these tariff increases get implemented.
This sort of gives them cover not to do very much for some period of time as they sort out what's going on.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The reluctance to offer guidance. You heard it there from Kevin Gordon at Charles Schwab. The fog right now is so dense. We just caught up with a Fed official. Did not want to be pinned down on anything about the future. Did not want to really have a conversation about what tariffs might mean for policy. As for the bias to ease, what bias? Are you thinking about hiking? Don't really want to talk about that either. A lot of people are in that position right now.
As I was thinking, with all of those comments, how many ways can you say, I have no clue? And that is what everybody is doing again and again because we have no clue. We have no clue about the headlines. We have no clue about what the tariff regime is going to be exactly in the end. And we have no clue exactly where the economy is going to break. At the moment, things look strong. At the moment, consumer confidence is strong as well as corporate confidence. How long does it take before that starts to shift?
You can have a plan, and then that plan can get overtaken by events. Let's check out Apple in the pre-market, softer throughout the whole of this morning. Reporting from the team here at Bloomberg that China's antitrust watchdog is laying the groundwork for a potential probe into the company's policies and the fees it charges app developers. We're down by 2%.
And Apple, of course, is a target because it's an American company. And also, it happens to be a big competitor with some of the national champions in China that provide phones and are direct competitors. Question about how much this is part of the tit for tat, how much this was something China was planning to do anyway. Real interesting to see in the earnings calls how much companies shift away from production and sales in China. We've already seen that.
Sure.
Does that continue?
Alphabet getting hit around earlier this morning as well. Alphabet is down and down pretty hard at the moment. It's down by 7%. The earnings came in on the growth side a little bit softer. And I'll be very careful about what I say because it was a cloud revenue business that came in just a little bit lower. And when that happens, you shift your attention to spending. And then you just see numbers like this, $75 billion in 25 CapEx against an estimate of $57.9 billion. You throw in DeepSeek the last week. Question we asked, it's not going to change the plans of the C-suite immediately, but will it change the patience of investors with those plans? And Alphabet this morning, maybe those investors losing just a little bit of patience.
2025 is going to be the year of the storyteller because Meta came out and had bigger than expected capital expenditure plans and told a story that people liked, and those shares went up. Google didn't have the same storytelling capacity here. Even though they're spending $75 billion, they plan to this year versus the $57.9 billion because they can't meet the demand. This isn't an issue of them spending into a void. This is just they don't have the capacity to meet all of the customers that want to use their services. Again, how do you spin this? Maybe they need to, put on the leather jacket.
The leather jacket?
Out there. Yeah.
Right, yeah.
Get out there.
Start telling powerful stories.
Untamed demand, untamed spending.
I can't see Sundar doing that, can you?
I think that might be part of the
I'm not
problem.
sure that's his thing.
Maybe he needs to, put on a necklace,
okay.
grow the hair out.
If he's watching, take up surfing and all of that stuff. All right. Not sure if that's great advice. That stock is down in the pre-market. The broader equity market negative by 0.4%. Coming up this hour, we'll catch up with the Chevron CEO, Mike Wirth, on the outlook for energy under a second Trump administration. Pooja Sriram of Barclays on the Fed setting up for a, quote, extended pause. And the Congressman Jason Smith on President Trump's tariff and tax policy. We begin this hour with a look at the energy sector. President Donald Trump pledging to expand production and lower prices with the threat of tariffs hanging overhead. For the next 30 minutes, I'm pleased to say that joining us now is the Chevron CEO, Mike Wirth. Mike, good morning. It's good to see you.
John.
I promised the first question earlier on this morning. I mentioned it on air. I wanted to know whether you've watched Landman on Paramount. Have you seen the programme?
I have.
OK, how accurate is it? Do you have to deal with cartels on a daily basis?
It is wonderful entertainment. Billy Bob Thornton is an amazing actor, and it's drama, right? And you need a little bit of a storyline. And so, there's certain aspects of it that are accurate, and others that are probably just a touch exaggerated.
It sets up this conversation quite well, I think, for one specific reason. I think there's been a vibe shift in this country, captured by the election in early November. And also, based on the content that people are consuming right now, including Landman. And in Landman, you see a much more pragmatic approach to things like fossil fuels, oil and energy, and the kind of work that your company does. Do you think we are seeing that, a more pragmatic approach to the energy story now?
I think there's no question we're seeing that. I mean, you take a look at this administration that has come in, and rather than criticizing and almost in some ways ostracizing oil and gas, it's an administration that has talked about American energy abundance and using that to the benefit of the American economy, the competitiveness of American business, but not just oil and gas. The grid is a big thing for the administration and power generation, and so I think we're seeing a more balanced conversation. It's something I've been calling for years. Is in energy there are three things that matter, John. Affordability, because that underpins economic prosperity. Reliable supply, because that relates to security and national security. And then environmental impact. And we have to balance those three things as we talk about energy. The conversation had become very unbalanced and focused on one of the three.
and not the other two. And I think we're seeing a move back towards a more balanced, and you use the word pragmatic. I think that's a very good word for the shift that we are seeing.
We definitely are hearing the shift in the conversation. We heard that at Davos, even though you weren't there. We missed you. I am curious about how much that translates into actual changes that you're making on the ground with how much you're investing, how much you're planning to expand your footprint in the United States and elsewhere.
Yeah, we grew production last year 7% globally, almost 20% here in the U.S., largest production we've ever had in our history. Largest cash distribution to our shareholders. So we are growing. We're also doing it in a more capital efficient way. So we've been focused on getting more bang for each dollar of capital. You guys are talking a lot about capital this morning. And in a capital intensive industry, we have to always look for ways to be as capital efficient as we can be and as disciplined as we can be. And so we're able to bring new energy supplies to the market at a lower capital investment rate than ever before. We'll grow again this year in the United States, another 10% or so in the Permian. So demand for energy is at an all-time high, and it's only going up.
Last year, you had a record production, even under an administration that had a very different tone toward the oil and gas administration, the oil and gas industry. I just wonder how the vibe shift will change what your outlook is at a time when the rhetoric has shifted to the positive, but some of the proposals like tariffs might be headwinds in certain places.
Yeah, so I think your point's a good one, Lisa. The rhetoric kind of sets the mood music, but you actually have to see policy, right? And some of that's done through executive order these days. A lot of it would be best done through legislation. And we would like to work with both sides of the aisle to implement durable, balanced and pragmatic energy policy. Things like permitting reform, which have gotten a lot of conversation, but we really haven't seen action yet on that. And it's difficult to build anything in this country, not just pipelines and infrastructure for our industry, but new power generation and grid modernization and other types of infrastructure. So we hope and are certainly willing to work with parties from across the spectrum to try to turn some of this vibe shift or more balanced conversation into what we think is good, durable policy.
Can you talk to us more about the permitting? These are things we hear about all the time. Sure. You're running a business. Could you help us understand how much that has held back your business?
Oh, it slows things down. It's very difficult. I mean, the Keystone Pipeline is a good example that was well documented, where a multi-billion-dollar investment that would have been good for Canada, would have been good for the United States, ultimately didn't happen because the permitting process can be hijacked by interests that are opposed to seeing investment in our economy. And so, look, everybody wants to see good protection of the environment and engagement of communities that are impacted by projects, but we need lead agencies that can take responsibility for these processes. We need timelines that are reasonable timelines to do the work, and then we need reasonable boundaries around the way these things can be litigated in the courts, and that needs to, that needs to be done to enable more investment in this country.
This president clearly wants to change that, uses phrases like drill, baby, drill. We're certainly drilling north of 13 million barrels of oil a day in this country, which is phenomenal. I often sit here, Lisa does too, and we'll say things like, and we'll hear it from Annmarie as well when she's here, how realistic is it to get that number much higher than the 13 million barrels we're at right now? You'd know it better than we do. How realistic is it?
Well, I think production in the U.S. is going to grow again this year. We certainly see in our business, I said our Permian production will be up 10%. In the Deepwater Gulf of America, we're going to go from 200,000 barrels a day to 300,000 barrels a day by the end of 2026. So there is production growth coming, but it's really driven by economics, a long-term view on supply, demand, technology, and policy.
Just to jump in, that last point, a long-term view on policy. How difficult is it to make these investment decisions? We talk about this vibe shift now. Could change again in 4 years.
It's very difficult, John. And so one of the things our company was criticized for a few years ago is we weren't jumping into some of the renewables as fast as others because the policy was unclear. And so we were doing basic research. We were investing in pilot plants, but multi-billion-dollar investments that are very dependent upon policy that could change quickly are something you have to think about when you're looking to deliver strong returns to your shareholders. And so we would like to see durable, long-term balanced policy because that does make the investment decision a little bit easier for companies to make.
One test case for this is liquefied natural gas. The U.S. is a massive producer of it. You're one of the biggest producers of it. There was a ban on exporting to Europe at a time when Europe was really dependent on the U.S. That has been lifted. Now there's the potential of tariffs being placed on some of those exports. How much can you start to lean into exports versus not due to some of this confusion?
Yeah, you know, the tariff environment is obviously evolving here on a daily basis. Energy is a globally traded commodity, and LNG, oil, petroleum products, for the most part. Now, Canadian oil is a little bit different because it's really dependent upon pipelines, but those products can go to different markets. We've seen sanctions reorient trade flows. Tariffs are another instrument that can change the economics for producers and for consumers. And what you'll typically see, whether it's LNG or oil, is flows will move to different markets as producers seek the highest price for their production and as consumers seek the lowest cost for what they're looking to buy. And as long as supply remains in the market, you have markets well supplied, you generally start to see costs go up a little bit because there's increased transportation and some kind of friction in the system. But export decisions aren't heavily affected by those prospects, I would say.
Speaking of sanctions, just briefly, you have a waiver to operate in Venezuela. Is that the case?
We do.
Senator Rubio, now Secretary Rubio, said maybe the US should reconsider that waiver. Are you in contact with them on that issue?
We're in contact with the current administration. We've been in contact with the first Trump administration and the Biden administration because the sanctions on Venezuela have been in place for years. And we work closely with the government to understand their objectives, to understand the limitations that are being placed through these licenses issued by OFAC, and to stay in full compliance with the law.
Are you anticipating any changes at all, or too early to say?
Yeah. There recently was a trip down to Venezuela by a special envoy who brought back some Americans from Venezuela and arranged terms for, I think, Venezuelan immigrants to go back to Venezuela that are here illegally, and that seems to be, you know, the latest. The general license that we operate was unchanged. It has been changed over the years in different ways, and that still could happen. We try to inform the government of the potential ramifications of a change like that, so they're well informed before they make changes in policy.
What would the ramifications be?
Well, under the initial Trump sanctions, Venezuelan oil was not allowed to come to the U.S. The Biden administration changed that. Gulf Coast refiners actually run a lot of the heavy grades that come from Venezuela. If you see sanctions on Canadian or tariffs on Canadian or Mexican oil, that may send some of that oil to other countries. And so the Venezuelan oil could be even more important. So it's things like that. It's how would this work through the system that we really try to help the policymakers understand.
Mike, you're going to stick with us, I'm pleased to say. More on that conversation and more in just a moment. Mike Wirth there, the Chevron CEO. Crude at the moment in the mid-70s. Billy Bob says that's a sweet spot, right? Mid-70s for crude. You've watched that?
I'm glad that's where you're getting your research.
Billy Bob Thornton's like mid-70s makes it work, you know. Anything lower than that's a bit of a problem.
This is how Jonathan Ferro does his research.
That's how it works.
Yeah, basically.
That's everything I know about energies from Loma.
That's basically,
yeah, of course.
This is the secret, the trade secret.
Let's give you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hecker. So, Yahara.
Hi, John. An update on a story we reported on earlier this morning. The U.S. Postal Service says it will continue accepting all international inbound mail and packages from China and Hong Kong Post. The USPS and Customs and Border Protection are working closely to implement an efficient collection mechanism for the new China tariffs to ensure the least disruption to package delivery. Meanwhile, Honda and Nissan said they're withdrawing their agreement on merger negotiations. The two car makers were unable to agree on terms and will consider whether to hold integration talks again or only collaborate in some areas. Without Honda's backing, Nissan's future is unclear as the company faces chronic issues, and that's why Nissan shares ended lower in Tokyo trading. And shares of Chipotle are falling some 5% in the pre-market. The company reported fourth quarter same-store sales that missed Wall Street estimates and says it expects low to mid-single-digit growth for the full year. The burrito chain also said it's preparing for possible tariffs by exploring alternative suppliers for foods like avocados and tomatoes. That's your Bloomberg Brief. John?
Yahara, thank you. Just turning our attention to the ADP report. Upside surprise, 183 is the number. The estimate was 150. More on that in just a moment. Up next on the programme, we'll get you some morning calls as well. And later, the House Ways and Means Committee Chair, Jason Smith. You're watching Bloomberg Surveillance. Equities on the S&P 500 negative here by close to 0.5%. Economic data out just moments ago. Mike McKee has an update. Hey, Mike.
John, as you mentioned, it was an upside surprise, 183,000 for ADP in terms of January payrolls. Last month, revised up from 122 to 176. Of course, we had a big increase in non-farm payrolls last month that wasn't expected either. The forecast on ADP, 150,000. Interestingly, there doesn't seem to be an impact of the California fires on these numbers. It's not mentioned in there, but also when we look at the regional breakdown of jobs, the West had the most, 70,000 additional jobs added. So if there is a Los Angeles issue here, we're going to have to wait and find it in non-farm payrolls. The only thing that stands out in terms of industry sectors, manufacturing loses 13,000 jobs. Leisure, hospitality, trade, transportation, and utilities are the biggest gainers.
Mike McKee, thank you, sir. The number, if you are just joining us, by the way, 183 against an estimate of 150. Mike mentioned the big one on Friday, the payrolls report just around the corner. Lisa, a sneak peek of our survey, 170 is the median estimate in our survey, 170. The previous number, of course, 256.
I will also flag that we'll be getting a revision to some of the ways that they measure the labor market. And you could get some downward revisions to the 2024 numbers for the labor market that make it look a lot weaker. That might be the more interesting aspect of this Friday's labor market report.
Friday, 8:30 Eastern time, so look out for that. Let's get you some morning calls. Let's kick it off first up with Mizuho downgrading Hilton to neutral, citing limited upside at its current valuation. The stock is down by 0.7%. Your second call from JP Morgan cutting its price target on AMD to 130, noting a muted outlook for data center growth. And finally, Guggenheim lowering its price target on Alphabet to 215, saying slower crowd growth and its high capex estimate are weighing on sentiment. Their stock is down by 7.4%. The Chevron CEO, Mike Wirth, is back with us. Mike, good to see you. Let's extend that conversation and pick up on one of those calls, data center growth. There was a conversation only 2 Mondays ago about whether we've been overestimating the extent of data center growth we'd see, and alongside that, the amount of energy we might need. Did the DeepSeek story of the last week or so change your outlook at all?
It really didn't. If you look at the incredible capital spending that you've been talking about and the huge demand for increased compute from all the big hyperscalers, I think they all assume you're going to find more efficiency in the development of these models, the training and inference techniques that are used, and at the same time, we're going to need a lot more compute capacity. So the two big constraints are GPUs and, interestingly, electricity. You know, we haven't seen real growth in demand for electricity for the last couple of decades in this country. We have taken a lot of reliable baseload power off the grid as coal plants have been shut down. We've had a lot of wind and solar, which are great and very low emissions, but they're also intermittent. And so the grid hasn't been modernized, the power generating capacity hasn't changed much, and we're poised to see demand from data centers, from the electrification of the vehicle fleet and other parts of our economy. And so there's a range of estimates, but I think nobody would tell you the demand for power isn't going to go up, and probably pretty significantly over the next few years.
That feels like a year ago, by the way. DeepSeek? What?
I know.
Honestly, it's just sort of amazing how quickly this goes. How do you sort of gut check people's understanding of the energy use that is required for this? And how are you planning to build out your footprint, what type of energy you want to invest in, and what your budget is like for that?
Yeah, so we talk to the people that are doing the work, right? And we're a customer of all the big tech companies, right? They help us in many different parts of our business. We've got relations with them. So we're looking to use these tools to improve our business performance. And over the last couple of years, the conversation has flipped, and they've said, how can you help us be sure we've got enough power at scale in order to deliver the products that you're looking for? And one of the things that's very clear is the hyperscalers want to move fast, right? There's a bit of a land grab, and you see it in the way the capital budgets are going up. And so things that are at a scale of 100 megawatts, 200 megawatts are different than gigawatts, which is really where their ambition is. What we've done recently is announced a venture with GE Vernova and a company called Engine No. 1 to collaborate and bring 4 gigawatts of power to market beginning in late 2027. So relatively soon, 7 of GE Vernova's biggest turbines that we've got delivery slots on. And the intent is to site those in places that can meet the need of these hyperscalers reliable gas supply so that they can have long-term confidence in the energy off the grid, so they're not going through the grid and dealing with interconnect queues and the reliability issues, and ultimately also a desire to try to integrate lower carbon energy into this, whether it's through carbon capture, hydrogen, geothermal, and other technologies, something we know a lot about.
You said turbines, and those are natural gas turbines.
That's right.
How much do you think that natural gas could potentially overtake diesel and some of the gasoline that people use to fuel a lot of what currently gets generated?
In electricity, you're going to see, we've seen historically good demand for gas, and you're going to see more of it. You're going to see demand for gas for exports and LNG, as we were discussing earlier. In transportation, its use will be more limited. It has certain advantages, but certain disadvantages when it comes to vehicle transportation. And so I think you're going to see conventional gasoline and diesel, along with electric vehicles, really power the light-duty vehicle fleet and the heavy-duty vehicle fleet for the foreseeable future. I think you're going to see gas more in power generation and other parts of the economy.
Before we let you go, I know that the Hess thing has been messy. It's going to potentially close later this year. I know that there's a lot that needs to get worked through. Once that's gone through, how in the market are you to potentially consolidate? Because a lot of people are saying this is a market in the United States that still has a lot of consolidating to be done.
Well, we're first and foremost focused on the Hess transaction, and that will conclude later this year. We're always looking. We're a resource business. You're always looking to acquire good quality resource that makes your portfolio stronger. We've got a great position today, so we don't need to do anything. We would only do something if it really fit for our company, if the price were right, and it would create value for shareholders.
What type of industry, though? You've got natural gas, you've got oil, you have other types of forms. What would be the area you'd want to expand in?
Well, there's a couple of areas that are always of interest to us. One is oil and gas resources, because every day as you produce it, you have less in your portfolio. And so you need to replace that. We do it through exploration by finding new fields. We do it through technology to improve recoveries, and we do it through acquisitions. The other sector that's got really robust demand growth is petrochemicals. And as we have a larger middle class in this world, as we move towards more fuel-efficient modes of transportation and lighter weight airplanes and vehicles, much of that is the materials that go into that are derived from thermoplastic petrochemical products. They have lightweight, they have good durability and other rigidity and mechanical properties. So demand for petrochemicals will be strong. That's another sector that we'd be interested in.
Mike, this was perfect. Appreciate your time. Mike Wirth, everybody, from Chevron. Equity futures right now are negative by 0.4% on the S&P 500. We are down by 0.6, 0.7 on the Nasdaq 100. Lots to talk about there. Alphabet, Apple. Switch at the board and get to the bond market. We'll talk about that a little bit. Bond yields are lower by 5 or 6 basis points on 10s. On 2s, we're down 3. Earlier on, we had the ADP report. Actually came in better than expected. An upside surprise of 183 against an estimate of 150. And bond yields, this move, sticks. Didn't turn around, Lisa.
And part of that is because, frankly, what we're seeing is a completely stable market where you see jobs that are being offered and people can get them, but not a significant uptick in quitting and not a significant uptick in hiring. So nothing to really change the story.
Got you an update on bond supply. Certainly pertinent to the discussion we're having this morning. So let's get to Mike McKee for more. Morning, Mike.
Morning, John. Let me just mention quickly that one number to rule them all. The trade balance comes in at $98.4 billion, much higher than $78.9 last month. These are December numbers. Remember, we had that big blowout in goods trade last week. This is goods and services, a little bit smaller, but it does have an impact on growth, and it does have an impact on politics going forward. Now, to the numbers you were talking about in the Treasury Department. This is refunding day. Treasury says they're going to offer $125 billion in securities to refund $106.2 billion in maturing securities, raising only $18.8 billion in cash. That's the debt limit. No auction size foreseen for the next several quarters, they say. They're going to remain the same, but they caution that the debt limit means that there's going to be significant variability in bill issuance and cash management bill bills. And for now, there's no change to buyback plans. Remember, the Trump administration doesn't have people in place here, so this was not a refunding that people expected them to make big changes. Here's the numbers: $58 billion in 3-year notes next week, $42 billion in 10-year notes, $25 billion in 30-year bonds. And then one caution, the Treasury surveys dealers, and according to dealers, they think the U.S. is well funded for fiscal year 2025, but there will be significant gaps in funding for 2026, which suggests they're going to have to raise auction sizes. For that, they got to raise the debt limit. So that's something to keep an eye on. The bond market will be paying close attention to that.
Yeah, Lisa too, that's for sure. Mike, thank you, sir. Michael McKee on the latest. This story is going to change a lot in the months to come.
And I will be tracking it much more than Moana 2. I just want to set the record straight once again. But honestly, this to me is actually the big story of 2025, which is the auction sizes, especially because Scott Bessent came on this program and said that he wanted to term out some of the debt to remove the variability of some of the borrowing costs that the U.S. pay at a time where it doesn't seem like costs are going to go down that much. Does he go through with that, and how does that affect borrowing costs?
And Stephen Mirren as well, who co-authored that piece with Nouriel Roubini at Hudson Bay Capital, I think, to close out last year. Stephen Mirren's now in the administration, and he complained about the activist Treasury issuance under Secretary Yellen, issuing all that stuff at the front end.
The theory was they were issuing on the front end, where there's a lot of demand, to avoid locking in longer-term borrowing costs of 4.5%, given that they expected them to go down. And if they issued it, they thought maybe borrowing costs would go up. Well, now is the test. Do they lock in 4.5% borrowing costs? And if they do sell debt in bigger numbers on that side, how much do you see that borrowing cost go up?
You've really got it in for Disney this morning, haven't you? And that
I
movie.
don't have it in for Disney. Right. I loved Moana 1, and I took my kid to see Moana 2. He's too old. I understand. I did it partly for me because I like Moana 1. But let's just move on. Classic. And I just found it disappointing. It was just pulling on the same sort of heartstrings of the first one without the same kind of innovative, I don't know, just nuance.
I haven't watched either.
It's okay. Just leave it there.
OK, someone just wrote in and said, remember when you ruined Shogun? Remember that? Don't ruin Moana 2 for people.
You just made that up. No one actually just said that.
It's there. You can read it too. It's addressed to you as well. In the bond market, yields down by about 3 basis points on the 2-year. You see it now? Yeah. The 10-year down by about 5 or 6 basis points. Joining us now, Pooja Sriram of Barclays. Pooja, welcome to the programme. Some economic data out this morning. ADP out with a bit of an upside surprise, looking ahead to payrolls on Friday. Are you getting a clearer picture of where the labour market is, and what does that picture look like?
Hi, good morning, John and Lisa. We've been saying that the labour markets have been holding up pretty well. Sure, there's been some easing, but it's been pretty disciplined, pretty consistent. Looking forward to Friday's data and after looking at today's ADP, it does look like we're going to get a pretty decent print on Friday. Our own forecast is for 175K increase in non-farm payrolls. We expect the unemployment rate to be at 4.1%. So really, we think, labour market still holding on, looking in decent shape.
One big question people keep having is, where are we currently, given that we don't know where we're going? And one thing that we're going to get on Friday is the revisions to the methodology that the Bureau of Labor Statistics uses to estimate the employment rates. Pooja, how concerned are you about an inferred downgrade to the number of jobs that were created last year that really reduces some of that optimism about exactly where we are in the strength of the labor market currently?
Yeah, that's a good question. So, we're going to get a lot of new information on Friday. One, of course, is the benchmark revision to the non-farm payrolls data. And as you know, that really is to the level of employment for the last 12 months. So really, we're looking at last year. The picture could look a little softer, like you said, where, we see the average monthly gains in payrolls looking somewhat smaller than what was reported previously. Now, if you look at that and, pan into what we're going to see or what we've seen in the past couple of months, it will look like, fairly disciplined gradual slowing. In our view, nothing to be too concerned about. Now, the one bit that is quite tricky for us to forecast, but we will see details of that on Friday, are the birth and death rate adjustments, so what we call the CPS population weights. That's the one that would affect the household survey, potentially estimates of the unemployment rate as well. And, it's hard to quantify that. We don't know in which direction that would go. And I think that will be the key data points that we'd be looking for.
I'm just sort of surprised at the measure of revisions that we've seen recently. And it's raised this question about the accuracy of government data coming out. Bloomberg Intelligence expects that actually job growth didn't really increase enough last year to cause the unemployment rate to be where it was if you take into account some of the expected revisions. How much more are you using data from ADP or Indeed or one of these other job search engines rather than the government to get a true gauge on what's going on?
Yeah, I think that's a great point, Lisa. Response rates have been on the decline. It has raised concerns about, the data itself. And so, this is the way I would say it. We're looking at what the government puts out. They've got a good track record of doing what they do. They know what they're doing. But at the same time, I think it's useful for us to look at alternative measures. So indeed, for us is, like you said, a good measure. It gives you a sense of the dynamism in the labor market. So, job openings, quits, etc. And, ADP as well adds some good color. So I think right now, rather than looking at a particular metric, the approach that we're taking is to, look at a dashboard of indicators to get a sense of where we are.
Pooja, appreciate your input this morning. Thank you. Pooja Sriram there of Barclays. On the jobs data we're seeing at the moment, going into payrolls Friday, which of course is just a few days away, Citi's Andrew Honhorst made the point that this low churn dynamic, these low churn dynamics that you're seeing in the labour market, just not much hiring, not much firing, he says is inconsistent with a healthy labour market. I'd go on to raise this question. If that is inconsistent with a healthy labour market and the Federal Reserve should still be considering reducing interest rates, but they're not because they're worried about the policy outlook, not cutting when you should be cutting is slightly problematic.
It might be the reason why you're seeing this bear flattener. And what that means is essentially high short-term rates with the long end of the yield curve, long-term borrowing costs going lower. Because what this indicates is that maybe people believe that this Fed policy rate is getting increasingly restrictive if the labor market doesn't have the same dynamism. That's one argument.
Yeah.
There are many people with the exact opposite argument, and we'll have them on and discuss that.
Another 250 on Friday, and we won't be talking about that anymore.
Absolutely.
It'll be a very, very different
ignore that we said that
conversation. I just got an email from terminal subscribers who are all in on this story with you. Agree with Lisa. Moana 2, what a clunker. So disappointed. Jonathan, don't go. Stick with the Six Nations rugby.
Just saying.
Apparently you're not alone. There's a lot of parents out there that probably got dragged to that.
We all got dragged to it. Or some of us dragged our kids to it.
Well, your son got dragged to it by you. That's different.
He enjoyed it more than I did, frankly. But yeah, it was just not a very sophisticated storyline. It kind of, let's not just...
I agree with something someone else said. Every time you review this movie, this review gets worse.
Let's move on. Come on.
Let's turn back to Washington. Lawmakers reacting to Trump's tariff plans and their implications. Annmarie is there with a special guest. Annmarie, over to you.
Thanks, Jonathan. Well, there's a lot of debate, maybe not as much as what's going on with Lisa and her household, but a lot of debate on how their Congress is going to enact Trump's package when it comes to enacting his agenda. And I'm joined now from Capitol Hill by Jason Smith, chairman of the House Ways and Means Committee. Congressman, thank you so much for your time this morning. I'm sure you've seen all the reports that a lot of House Republicans are actually talking about now the Budget Committee maybe going for a two-track approach. Is the one big, beautiful bill just too heavy for Congress?
The one big beautiful bill is the best and quickest approach to get as many of the president's priorities delivered to his desk as possible. The House is focused on one big beautiful bill. It's the Senate that continues to say that they're going to do two. But I would just remind all of my colleagues, look at history. It has been 38 years since two different reconciliation bills were signed into law in the same year. We have the smaller majorities in the House of Representatives now than in the history of Congress. Why do we think we can defy those odds is beyond me. So if they do two different bills, the first bill has to have tax policy in it.
Well, you talked about the senators. They're going to be having dinner with President Trump this weekend at Mar-a-Lago, and they're going to pitch them on this approach. And they are ready to go, where the House doesn't seem as ready to go. At some point, do you and all your colleagues just need to stop focusing on process and actually get a bill to the floor, which seems like the Senate might beat you?
The Ways and Means Committee is ready to deliver the tax policy now. Unfortunately, we have several members that are putting their agendas above the agendas of the American people. And that includes senators who are wanting to get a skinny bill to get some of their easy wins. We need to deliver for the American people. They want certainty. There's 26 million small businesses out there that are making the decisions now of how to invest, how to hire for next tax year, not knowing is their tax rate going to be 43.4% or 23.4%. Congress needs to act quickly. Don't get involved in the process. Deliver and put on the president's desk now.
So is your fear that if you go towards this two-track approach, the tax bill can get pushed back to the fall or maybe even later?
I am fearful that that is the plan, as they're trying to push the tax bill to the fall and later. The problem is that there will only be one reconciliation bill that will be signed into law this Congress. One. And if they want tax to be included, they better make sure it's included. And that's what I tell my colleagues over in the United States Senate, is we need to act now. Do not wait for a later date. Problem with Congress and why American people get upset all the time is they're tired of politicians kicking the can down the road to worry about the issues of today for tomorrow. Let's get our job done now. Stop kicking the can and deliver for the American people.
Senators would say, though, that they want to act swiftly because Donald Trump was really elected on one key issue, and that's immigration. Potentially, do you think Trump is going to see that that's the right path forward if he wants to get a quick win?
President Trump has said that he favors a big, beautiful bill, but he'll take whatever it takes to get his priorities acted in law. The senators, I would say, would be wrong on the statement to saying that President Trump was elected because of the immigration issue. President Trump was elected on two different priorities, and that was the securing the border, and that was creating economic prosperity. And part of economic prosperity is to make sure Americans aren't facing the largest tax increase in the history of America on the watch of a Republican White House, Republican Senate, and a Republican president.
With very slim majorities. So when it comes to the House, you're going to need some of those New York Republicans to get, or all of them, to get this over the finish line. I'd love to get a sense from you on where you are with the Republicans from New York and other districts that have high taxes, and they are concerned about this SALT debate.
First off, to get one big, beautiful bill across the finish line is going to require everyone working together and sticking together. It's not going to be easy. If people think it's going to be easy, they are mightily mistaken. We've been working with all the different members of the conference, whether they're SALT members, whether they're debt deficit hawks, whether they care about various green credits in the IRA. We have a very diverse conference. We cannot lose one member. We have a 217 to 215 seat majority after Elise Stefanik is confirmed over in the United States Senate. We can't lose anyone. We have to thread the needle, and that's in fact what we're doing with the SALT. Everyone has to give. You're not going to get everything that you want. Everyone has to give. There has to be a balance, and that's the only way that we can be successful and deliver for the American people.
So on SALT specifically, though, it sounds like you might be close to clinching a deal, raising that cap. Do you have a ceiling of where that cap can go?
We definitely have to raise the cap. There's no question that the $10,000 cap that was put in 2017 would be tolerated amongst our SALT members in New York, California, New Jersey. And so we'll definitely raise it. I'm not going to give that number, but we're going to find a good balance that's going to provide a lot of tax relief for the majority of their constituents.
As you're debating tax policy, the President of the United States is coming out with a number of directives when it comes to tariffs. At the moment, a lot of them are on pause, but of course, his China 10% went into place this week. Whether or not it's one bill or two bill when it comes to reconciliation, how contingent are tariffs as a revenue raiser for what you're trying to get done in Congress?
Well, because of the process arguments and the rules of reconciliation, the revenue from tariffs cannot be counted that the president implements by executive order. But when you look at the entire fiscal health of the nation, which every lawmaker should be concerned with, absolutely tariffs will bring in billions of dollars of new revenue. In fact, what the president proposed on Saturday, at minimum, according to the Tax Foundation, says would bring in $1.2 trillion of new revenues. And then, of course, the president on day one of his presidency signed an executive order demanding Treasury, USTR, Commerce to look at trade practices throughout the world and report back to him on April 1st of those actions. I think you'll see additional tariff actions after April 1st based on that research.
So given that, does the tax bill then need to take shape after April 1st, when you and your colleagues have a better understanding on the revenue raises it can bring in?
Not at all. I think that if you pay attention to what President Trump has been saying, you know exactly the direction that he's going to. He's campaigned on this throughout the whole time, and that is what we're going to do. We know of the economic pro-growth tax policies that need to be in place to help our economy, grow our economy, and help provide relief to working families.
Trump also announced a plan to create a new agency when it comes to tariffs and collecting these revenues, the External Revenue Service. There hasn't been a lot of talk about it, but you know this would require an act of Congress. Do you see this taking shape?
I think it's a really good idea. We need to be looking
But doesn't it already exist, Congressman? Doesn't it already exist with the Customs and Borders?
You know, that's very debatable. Some people would say that it is. Others would say no. What President Trump is, he's definitely going to focus on America First trade policy. He has done more in the last 16 days when it comes to international trade than what the Biden administration did in the prior 4 years. The Biden administration was out to lunch when it came to trade policies. That's why we saw, for example, the agriculture trade deficit rise to over $35 billion under the watch of Joe Biden. But when President Trump was in office, we had a $5 billion agriculture trade surplus. President Trump cares about fighting for American farmers, manufacturers, and workers, and that's in fact what he's doing. And the External Revenue Service is just another measure that he's going to be, another tool that he's going to be pushing forward to do things differently. He renamed the Gulf of Mexico the Gulf of America. President Trump, expect the unexpected. He's going to deliver real results for the American people.
Well, that's certainly a certainty. Expect the unexpected. Congressman Jason Smith, thank you so much for your time this morning. Jonathan, of course, that was chairman of House Ways and Means. He's been pushing for this one reconciliation package. This debate is not going anywhere because senators are having dinner with the president, according to reports this weekend, and they are going to pressure him and try to get them on side for a two-track approach.
Annmarie, thank you. Appreciate it. Watch this space. On the Gulf of America, wasn't lost on you, was it?
Oh, no.
Did you notice it? Mike Wirth, Chevron? Just dropped it in there, Gulf of America.
Yeah,
just very naturally.
Smooth. He's all
super
smooth. Yeah.
Super smooth.
But he said, you know, Gulf of America. He's actually come out and done that actually on the earnings call. He talked to Gulf of America. Exxon has not done it yet. Pick your battles.
They'll follow. We'll see. We'll see. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hacker. Say, Yahara.
Hi, John. Disney shares turning lower, down 1.5% in the pre-market, even though first quarter results came in strong thanks to hits like Moana 2. A solid performance in its streaming operation and film studio led to a 31% gain in operating income in the quarter. Those gains offsetting what was a tough quarter otherwise for Disney's TV networks and its theme parks. Meanwhile, President Donald Trump says the U.S. should take control of the Gaza Strip. Speaking at the White House alongside Israeli Prime Minister Benjamin Netanyahu, Trump said the U.S. would dismantle weapons and turn Gaza into a Riviera by displacing its residents to other countries. Trump's proposal was met with sharp opposition from Palestinian and Arab officials. And switching gears here, President Trump announcing he will become the first sitting president to attend the Super Bowl in person. A spokesman for the Secret Service says extensive planning and coordination has taken place for Trump to attend the game in New Orleans. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead as we count you down to Payrolls Friday, just a few days away. Live from New York, this is Bloomberg. open about 36 minutes away. Equity futures recovering just a touch. We're down by 1/3 of 1%. Lots to watch, particularly in tech. Let's get you some movers. Here's Manus Cranny. Hey, Manus.
Jonathan, good morning. You've been talking about this throughout the morning. Alphabet, what is the takeaway here? Cloud, search, and AI. On the cloud, less than the market had anticipated, and we have a capacity constraint. Therefore, who's winning the other parts of that business? In terms of the CFO's message, it is about the available capacity. They need to build on that, and they are doubling down on their capex, $75 billion. So again, very much a clear message. That could have an impact on the free cash flow. AMD, roll it over. A company in transition, product transition. Let me just give you two numbers. Their high-end chips, $5 billion business. NVIDIA, it's $100 billion business. You've got to close that gap. And right now they're saying our data center business is something that we will deliver in the back end of the year. You do not have the room to wait until then. Let's close it off with Disney. You talked to the CFO. Clear message there. Subscriptions business will be $1 billion, double-digit margins. Churn is down. Those are the takeaways. And I didn't actually see Moana 2.
Manus Cranny, thank you. Of all the things we've done this morning, the big takeaway is Moana 2 and reviews on it. When does this movie even come out?
It came out a long time ago.
Did it?
It was months ago. Honestly, no, the takeaway should be Mike Wirth had some really interesting thoughts about the expansion of energy and just how much demand there is going to be coming from AI, and that the DeepSeek story was a head fake. Also, really interesting, Tom Barkin, basically taking no stance, but really looking forward to equal weights of potentially moving on either side. There are other things we talked about at the Moana too.
Okay, good stuff. Plenty to look forward to as well. Fed speak from Bowman, Gillsme and Jefferson later on this afternoon. Some data this morning too. Look out for ISM services. Amazon coming after the close tomorrow. We'll be talking about that name, no doubt. The main event on Friday on the data side of things. Payrolls Friday just around the corner. Tomorrow morning, Anwiti Bahaguna of Northern Trust, Jack Caffrey of JP Morgan, the Port of Ally Executive Director Gene Soroka, that's timely, and the LinkedIn co-founder Reid Hoffman. From New York, thank you for choosing Bloomberg TV.